Forbes called us best online for options trading. With stockbrokers.com, we're number one for options and futures trading. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Looking for a better broker and a bonus? Sweet. Get up to $4,000 when you open and fund a Tasty Trade account. Plus, smart tech and a broker who's got your back at Tasty Trade. Make your move, genius. Tasty Trade.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
Stocks rebound, close at the highs. What does it mean? It is Monday, January 13th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan of CNBC Celebrity in Milan. Here to take you through the next hour as we wrap up this futures trading day. What was a day defined by markets being down overnight as Asian traders digested that hotter than expected U.S. jobs report on Friday, turned into a turnaround Monday. S&P 500 closes up by about 0.2%. The Russell, which was down over 1%, finishes in the positive. The NASDAQ, which was again off by over 1% today, barely down by 1/4 of a point right now, or 1/4 of a percentage point right now, I should say. Bonds turn around a little bit here. Metals, however, get slugged. There is a reversal in the currency space for some of the major currencies versus the dollar, although the pound continues to get pounded. Oil breaks out to new highs, and the real 30-year yield hits its highest level since 2008. Are markets topping out? We're going to answer that all here in the next few minutes. If you're joining us on YouTube, come over to the platform, tastylive.com, see what we're about. If you're already on the platform or on Tasty Live, head over to YouTube, join the chat, tell us what you're trading today. Ilya, you and I spoke a few hours ago, and the reversal that we were watching over the course of the morning really did gather some pace here today. An S&P that was down near 58.10 is now back up at 58.74. It's a 1% swing and then some over the course of the session. Yeah. Same thing can be said for the NASDAQ and the Russell. Is this just a dead cat bounce as markets are in the process of rolling over?
I think we're going to find out really in the next 48 hours, because what this to me looks like is the market saying, right, what we cared about last week was the Fed and rates. And the message that we are sending out there is, when the data is hot, we're not going to look at it as, oh, good growth. We're going to look at it as, oh, no cuts or fewer cuts, rates higher. We saw that with ISM. We saw that with NFP. We saw that with the University of Michigan consumer confidence numbers. It was unmistakable each time. So clearly this week, we have a focal point implied therein, and it's the CPI report, because that's the next real inflection point in this story. So are markets going to run away this way or that ahead of that? Probably not. They're going to look for that number to come out to give them a sense of conviction this way or that. But of course, there was already significant damage done last week. So my sense coming in to this week, I mentioned it on last call with Tom and Tony just now, and we discussed it with Tom and Victor on first call at the open yesterday, this idea that markets now have room to correct and digest higher a little bit to sort of get themselves a little bit more neutral before the event risk. And then whatever that event risk brings, that's the real move. And if you look at what the S&P is doing here, it's basically testing the underside of the support that it cracked on Friday. It hasn't come back in to undo that breakdown. It's pushing up against former support become resistance. And so we'll see then how this develops. But at this point, this is still a market that's topping in my mind, but it's probably not going to make significant headway in that direction. It certainly didn't today, and it probably won't tomorrow in the way I sort of envision it.
Dylan, one thing that
And
we
your
talked
audio's
about
gone.
on the way up in this market was that when the market got a little bit too extended from its 1 month moving average, it was a cool off period. When you were more than 3% above that 1 month moving average going higher, the market tended to slow down thereafter. The same thing can be said on the reverse side. When we've been more than 3% below our 1 month moving average, it's been a turning point. We saw that here in December, on December 20th. We saw that here on January 2nd. We saw it again here at the lows this morning. We were more than 3% away from the 1 month. Why should bulls feel good about this? This seems like a market that's just stair-stepping lower right now. Why buy the dip?
Because the
You said you wanna
economy's
sell?
stronger than you think. The super glide is more powerful than you imagine. Deregulatory glory is about to abound upon your head. There'll be expedited permitting. The world's largest ever construction and new infrastructure boom is about to get underway in Los Angeles over the next 5 years. And get on or get out of the way, my friend. Banks,
I
real
think to
estate,
believe that, you have to
technology.
believe that the markets want growth here. And last week's data would suggest they don't.
That is a noticeable change in how the market's digesting things. Ilya, Friday on Futures Power Hour, we called the episode When Good News Isn't Good News.
Right.
I made the mistake, Dylan. One of my telltale strategies for the past years, as long as you've known me, if there's stock weakness on a good jobs report, buy the dip. Almost every time, right? Mm-hmm. I did that on Friday. I had to get new tires for my car. I figured, I'll buy the market's selling off. I'm going to buy some calls, just get back to where we were prior to the data, pay for those new tires. And it didn't work out. So not only am I out on the money on the tires, I'm also out on the trade, which was a zero DT, so there's no hope of recovery. But the point of it is that the market is not responding in the way that it used to. Ilya points out here, we had hot data last week and the market is selling off. Is this are you thinking that maybe there's a regime change?
Too soon to know.
Too soon to know if it's a regime change?
You're too soon to know. Because you don't know. I think there's going to be less and less activity. It's 1 week away. It's possible we get a full batshit crazy speech a week from today. I mean, if anything, it may be likely. I mean, this man does not operate in any normal domain of content. So who knows what you're going to get a week from today. But I think the market's going to sort of calm down and listen, because that I think will set the agenda for the next 100 days in terms of sentiment.
I'm curious as to what your bar is for crazy that would impact the markets, because last week we had a press conference talking about invading Panama and Greenland.
More of that.
More invading of Panama, more
Greenland,
more Greenland
Canada.
Wants to leave Denmark and would prefer to come over. Canada would prefer to become the 51st state.
I mean, I get the allure whenever I play Risk, and truth be told, I do play Risk on my phone. It's stupid. Something I do to kill the time sometimes if I'm waiting for the train. You take Greenland, you take Central America, helps you get that extra army bonus for when you conquer all of North America. And it prevents the armies coming over from Europe. Granted, that's not what we're playing right now, so it comes in a different context.
I like Italy and Spain. If we're just going to take countries, let's take Southern Europe. It's nicer, better food, nicer weather.
You like the Italian Riviera. Personally, if you want to exile me to Elba, that's fine. I'm happy to go.
I think we just, no, but I mean, I just think that the point is the number one Trump risk is inflation, and the inflation noose is tightening, not loosening, and still his two big headline policies, deportation and tariffs, are two giant inflationary forces. Lay onto that the jobs number, lay onto that the California situation, which is also inflationary, particularly when it comes to materials. We shall see.
Well, all of the Trump economic policy universe is inflationary. What the markets were balancing was, and we saw this in the FOMC minutes. Fed officials talked about this and cited business surveys that they were reading about this, that essentially the balance up and down for the economy was, okay, well, on the upside, the tariffs are like a tax and the deportations are a disruption to labor markets. That's growth negative, but deregulation and tax cuts are growth positive. Okay, yes, in the sense of growth, those things may have some offsetting dynamics to them. But in terms of inflation, all of it's inflationary. Tax cuts are inflationary, deregulation is inflationary, and the tariffs are inflationary, and the deportations are inflationary. And let's be serious here. Absolutely nobody is taking territory from EU member states, and that's Greenland. That's property of Denmark, an EU member state. So that's just not going to happen. Maybe we'll build a base there and claim victory. That would be something that's not taking over of Greenland. But it's these things being inflationary and the market being spooked by inflation that to me seem like the things that matter. Because everything we've learned here in recent weeks is the market is afraid of inflation and of rates. And all of the Trump trade narrative, good for growth, bad for growth, is inflation and higher rates.
Today, it seems like it's a story of divergence between tech and everything else. Maybe it's because of rates and inflation fears, although the way that oil moved today, it certainly didn't help anyone's sense of things. We can take a look at the commodities momentarily. But there's also talk of another chips ban. One of the measures that the incoming Trump administration might take, something that the Biden administration has been exploring and won't implement prior to leaving office, is how to prevent China from exporting certain goods and importing certain chips through third-party intermediaries, like Vietnam, for example. And we've seen this and we've talked about this ever since the sanctions against Russia went in place. All these countries that really didn't have a significant role in global trade, like your Kyrgyzstans, for example, see that their imports from from Russia and their exports to the EU jumped by like 2,000% over the span of a year. And the same thing's happening with some of these chips that are being imported and exported out of countries like Thailand and Malaysia and Vietnam. And so what the Trump administration says that they're going to be doing is that instead of trying to just scalpel a tariff here, what they'll do is they'll apply the 25% across the board tariff to this particular good for anywhere in the world. That way, China can't get around this by saying, like, well, we're importing it through Vietnam. We're not importing it from the United States. That good would now have the extra tariff on it. There's no loophole covered. So those bans are circulating, through the media. We've heard the stories the past 2 or 3 sessions. SMH, though, opens lower, trades lower, hits the trend line from the August and December swing lows today and finds a bit of a bottom. Last week, it looked like we may be getting a little bit of a breakout there. It obviously reversed. What's the play here right now? I mean, should we be just saying like this range is going to continue? Ilya, we talk about the seasonality of this market, January, February, March being chop. Should this be on our watch list just to look for another vol spike and then slap on an iron condor and see it in 45 days?
I am more so looking directionally at the NASDAQ itself, into which obviously this is a major input. With something like this, with 35 IV, it's not really anything that looks terribly attractive. It's been stuck in this congestion now, basically going back to the beginning of October. There's plainly not a kind of responsiveness here to what's going on in the broader equities narrative. And frankly, the broader equities narrative looks more interesting at the moment. So last week, I had separate of this an XLY short. I took that off today and took that PNL. Because it looks like
interesting place to take profit here.
Yeah. So I looked at this and said, okay, we're getting into areas of former congestion. Let's not get cute. Let's stay with the big indexes. There are big narratives being decided here. There'll be time for sectoral differentiation, but what happens next here is unlikely to be something that is having to do with this or that sector, this or that company, this or that narrative. This is about the cost of money. And we saw that last week. To Dylan's point, it's also about capacity for fiscal chaos. And so as we look at this, I'm happier to be in broader indexes and not trying to figure out what this or that pocket of the market is going to be.
Why wouldn't we just sort of get into a set of trades that benefit from rising inflation fears?
Because I think those moves are here. I think they've been with us since September. The real
so you think there's nothing more to be had in
there is eventually, but maybe not immediately. So the big concern for me here is, I think we all agree the bonds look really extended on the downside. The dollar looks very extended on the upside, and we're down to one cut being baked in for the Fed for this year. The markets have come a long way. So the risk, the surprise risk now seems asymmetric in the other direction. Let's say you get a soft CPI number this week, or a soft retail sales number, and the market goes, you know what? Yeah, okay, that there was a reflationary thing to do. We've done it. And now we're out of fresh news on this story for the rest of the week and into next week. Let's correct. So I wouldn't incrementally look to buy more reflation fear. In fact, I'm unwinding a little bit of it. So I took my Russell short off. I took XLY off. I'm just kind of backing up a little. I still have S&P short. I still have NASDAQ short. In fact, I rolled S&P forward to give myself some more time. But I think here it feels a little bit like, let's get to the other side of CPI and make sure the market doesn't get its catalyst to go the other way, because it seems like there's lots of itching for that to occur. Markets are just looking for a reason.
I mean, I could make a case that the dollar's more likely to go to parity now than it is to reverse at this point.
Now it's going to parity versus the euro.
Yeah.
Why wouldn't it?
The question is when.
Exactly.
Well,
Before it gets weaker. I think it's heading right now. I mean, this is where it's like focused on it.
I mean, the macro
if
story.
If the bonds bounce, that may be a hard sell.
I would love to sell 60 at 105 if bonds bounce from here, because the factors on the table, higher structural inflation because of the tariffs. That's the case, and the Fed's terminal rate's going to be higher, which the market is pricing in. And so how are currency markets adjusting? There's like a permanent yield advantage being baked into the dollar right now.
Yeah.
Because if you're going to have permanently higher structural inflation, that means the Fed will not be able to cut as deep as they want to in future cutting cycles, including this one. While you have a deindustrializing Germany, which is seeing some of its weakest manufacturing numbers since the global financial crisis, and no off-ramp for that. You have France, of course, which is France. Italy has been surprisingly strong under Meloni.
Italy's the leader. Italy is the global. Italy is both the political and economic leader of Europe, which actually should be taken as a red flag, because if everything has gotten so bad in England, France, and Germany, that the Italians are now the strongest economy in Europe with the most stable government, that is a compliment to the Italians. But
is it?
Or is it really evidence of a total self-destruction by the Germans, the French, and the British, basically all at the same time? And the Italians
yields in Greece are lower than France, and Spain
Giorgia
was
Meloni's
the outperforming economy last
in the world.
Year, globally, in the G10.
The most pressing issue in Italy is whether or not people have cappuccinos before or after lunch. Like they're not exactly as serious people. As one of those people.
Who moved to Italy? When did Italy become the global leader?
Shortly after Radigan.
Shortly after my arrival, I'll have you know.
Yeah. Yeah. And
Anyway, the point
unlike
is
the Commanders winning the Sunday before the election indicates whether or not it's going to be a Republican or Democrat, there's actually a causal relationship between your arrival in Italy and Italy becoming the premier destination for global leadership.
I think it's apparent. I mean, that's sort of self-evident.
Self-evident.
But it does mean that the euro's getting weaker, and it means that you're happy to have dollars lying around more than you are euros.
Yeah, I mean, looking for a euro bottom has been easily the painful part of my start the year. I mean, obviously, I've been short stocks. That's worked. But looking for a euro bottom has not worked at all.
102 now? I mean, this thing's ready to go.
Well, we talk about the trajectory of U.S. spending. Did you guys see what Elon Musk said about the spending cuts that he promised that would come through via Doge? In case you missed it, this is not
enlighten us, sir.
Elon Musk
probably
says
won't
Doge
happen.
Probably won't be able to find the $2 trillion in spending
Probably
cuts
won't happen. Sorry about that.
It was, I mean, it's sorry for everyone, I guess, Dylan, right?
Sorry
because we were promised $2 trillion in spending cuts, and we're not going to get them.
Not going to happen. I can't help it.
Maybe they find them over the course of a decade in some form or fashion. But this is the reality. I know I've seen the comments like, Chris, you're just a Musk hater. Chris, you just don't like Trump. You guys are all like just saw stuff. It's like, no, when you have a certain understanding of how these systems work, blue ribbon commissions don't have any statutory spending authority. And the money that they outlined that was being spent to waste, most of it was due to interest on the government debt. So if you're saying we're wasting $900 billion a year and $700 billion of it is due to, interest on the government debt, and then $180 billion is because of money being sent to the wrong places for accounting issues, it doesn't really seem like we can just cut spending to get to that 2 trillion number. Either way, though.
I thought we were supposed to grow our way to the number through super growth.
Yeah, that's the trickle down economics, right? Where the rich piss on everyone else, right? And we think
that's that inflationary is inflationary of the 4 pillars of Maganomics here.
You want to do the mega growth?
Yeah, I mean, it's just empirically, it's BS, right? Trickle down.
I mean, you do the mega growth, right? You cut red tape, you cut taxes, you juice up the economy, and then the Fed jacks up rates on you because they have to keep inflation intact on a reasonable path, or else you get pitchforks and torches because inflation went up again.
But don't you think that's going to piss off the big man?
Well, the point about the spending cuts is that they're not
I don't think the big man wants pitchforks and torches.
And they're not going to have them because you're not going to get the big, massive spending cuts that Republican congressmen are going to have to go sell to their constituents a few weeks before the 2026 midterms. I mean, it was never going to happen. But the point is, are you thinking about the bond trade then? If you're not going to get spending cuts that are substantial, because Doge was never really anything besides a shiny toy for Musk and Vivek Ramaswamy, who, by the way, where's Vivek Ramaswamy, Ben?
They pulled him as soon as he started insulting White. When he went off on Whitey during the H-1B thing, once he gave his opinion of old Whitey, asked him to stay. They got rid of him.
Well, no, that you're like being jocular about that, but literally, if people were watching the space in real time, Musk and Vivek were like, well, we have to hire foreign workers because American workers aren't skilled enough for the jobs that we need them for.
Because Whitey won't work.
And then the people say like, well, why don't you give us the education and tools to become those workers? And, Vivek and Elon are basically like, no, you guys are too stupid to learn how to do that stuff. So kind of alienating. He's been sidelined. Yeah. But so Doge, understanding what it is, taking it at face value, the spending cuts aren't coming. So that big deflationary impulse to the economy that could offset the tariffs, right? You raise tariffs, you lower spending elsewhere. The inflationary impulse is perhaps negated, even if it means growth is overall down. But even so, lower growth, that growth premium comes out along into the curve. You could have a lift in the bond market. We have to just reduce the probability of that from being like an outside, maybe Musk is able to get this done because he's going to bully everyone with his wallet and political donations, to probably 0% chance of being an impact this year. Off the board. So it's recession, right, or bust. The Fed right now has to see that inflation is dead, or we're going to get a recession to get the next rate cuts, because the Fed itself, with those minutes we saw last week, very much of the mindset that we are looking at, a lot of path uncertainty due to those tariffs, which today the 30-year real yield hits its highest level since the global financial crisis, in part because oil's been on an absolute tear here the past few sessions. Dylan, as our resident standing in front of the train guy when it comes to oil and who somehow does it so successfully, last week we were saying that this time feels different. It wasn't time to step in front of that train yet. So now that we're $5 higher and we're trading at the highest level since April, July, do you think it's a good time to short oil here, or still no?
I mean, the problem is I feel like I understand why you asked me, and I understand I had all that success, or some success, I should really say. But I feel like I was always just a geopolitical skeptic for World War III. And I feel like this oil move is more, I guess there's talk of the Russian pipeline being more restricted or something. I just feel like this move is not so explicitly Russian or Israeli like madness. So I have I'm inclined, just because it worked so well last year, to get in here and get some puts cooking, because how can you not? But I do feel like this move to me is a little bit less clear cut. In terms of being a setup for an automatic contraction.
Ilya, is this just people realizing how important oil is because everyone's watching Landman with Billy Bob Thornton on Paramount Plus?
That would be a more plausible theory.
Than China actually rebounding and driving this.
Yeah, than China rebounding or the fundamentals of this market actually changing. Because the reality of the situation is the U.S. is awash in oil. The U.S. could be more awash in oil. Were drill, baby, drill interpreted loosely mean, for example, retooling U.S. refining capacity to refine more of our own grade. The only reason that we really still import any oil is because our refining infrastructure is tuned not to what we produce in some sense. You need refineries to refine a certain grade of crude, and we're used to not refining some of our own output. And so we export that and then import stuff that we can refine. So if you were to kind of put a big, broad lens on what increasing energy output would mean, which is what the current administration seems to want to do, it would be higher records in output, turning on more rigs, turning on more fracking infrastructure projects, which have actually been coming down. There's been more of them shut off even as output has increased because we've become more efficient. So you have space. You could increase output. You could retool things. We're awash in oil. We could become more awash in oil. The geopolitics have only become more stable because Iran is very much on the back foot with their entire network falling apart. Hamas apparently on the verge of a ceasefire with Israel, if you look at the recent headlines over the past 24 hours, having been basically bashed into the ground. Hezbollah essentially now off the field, and the collapse in Syria basically meaning that Iran can't supply weapons and various equipment and material to the proxies that it supports. So you have a situation where the geopolitics, at least in the Middle East, are more, not less stable. And so it's the kind of thing that seems to ultimately give way to weaker oil. I agree with Dylan. I think this melt up here is not about geopolitics. It's more about growth. What we've seen is hot U.S. economic data suggesting that there's more growth, there's more demand. But now you're getting to a place where that's probably running out of steam as an incremental story, just because supply is so abundant.
Yeah, I mean, oh yeah, sometimes better be lucky than good. A
Yeah.
narrow miss here for me, although the way I was going to structure the trade, it wouldn't have been painful. Last week we were discussing what it would be looking like on Wednesday if this was a potential topping candle. Not quite. You never got the close below the Tuesday one and hugging
Right.
that 1 week moving average. At the time, we said if you wanted to be short, you do it through short MCL or long out of the money puts, long at the money puts, but not shorting calls simply because volatility was so low. And given how volatility and oil tend to behave together when there's a problem, vol spikes, price spikes, you get double tapped. So at least there's that, right? Not obviously a good idea to be short, but at least if people did do it, perhaps in a manner that was not as harmful as being short the calls themselves. I still think it's in that same place where it's harmful to be short the calls. Is what I'm rounding around to, right? If I wanted to be short oil here, if I wanted to do it, you could do it in a risk-defined manner, short the 80, 82 call spread. The vol isn't that high. It's a 38.2 IVR, and we've seen some much bigger vol spikes recently. The IVRs, last time we were around these price levels, you can see the IVR back at the start of August was up in the 70s. So if we can get something a little bit more, you could potentially try to do something here or even step back and we go to a weekly time frame and we think about how we're really nearing the top side of a multi-year range. We had that explosion higher in 2022 around the Russian invasion of Ukraine. Of course, that doesn't really filter into the longer dated futures contracts. That was more about a short-term supply disruption, which is why the front months exploded into the $100+ barrel oil, and that doesn't really happen here. But either way, this is the psychological hurdle, right? There is a very big ceiling here in the CLG5 contract up around 79.80. So from my perspective, if we can get a little bit further expansion of volatility, if we can see some semblance of a turn, maybe on a lower term time frame, like a 4 hour, a break of this clearly very, very strong momentum, perhaps it's worth taking a stab. But right now it's standing in front of a train. And Dylan, you mentioned that your sense of this, your sensibility about this has been around these geopolitical issues when the market's pricing in World War III, which in our experience, it can only happen once. So you might as well fade it.
But I don't think that's what this is. This feels
That's
different.
Exactly. It feels different this time, which is why I keep asking Ilya, is this about China? Because you don't get this kind of push higher in oil prices unless there's some real significant rethinking about supply demand dynamics in the very short run. This is up from 60 something, $65, $67 a barrel in December to 78 here. That's not an immaterial move. That is something that's going to impact people's spending.
There is one way that this becomes about China without China manufacturing more growth, which they are very much struggling to do. And that's just in the arithmetic of a ceasefire between Russia and Ukraine. The Trump administration clearly has lots and lots of appetite to get that conflict wrapped up. If that happens early, and if that's what the markets are speculating on, then you get a situation where a lot of the off-market deep discount oil that China has been buying from Russia for the past, let's call it 3 years almost now, that comes to market. That stops existing in a gray zone, or at least potentially. And
that's actually one of the explanations that I've read over the weekend, that because of how the U.S. has been enforcing sanctions over the past month, China and India have not been able to go through and buy Russian supplies. And so the reason why you're starting to see higher oil prices is that there's now legitimate Chinese and Indian demand making its way back to the market, which, sorry to interrupt you there. I want to point out something that we've discussed previously here. End of sanctions being bad for India's stock markets. Yeah. Bad for, right? We talked about this in November.
Yes.
India's ETF just hit its lowest level since March 2024 in today's session.
Exactly. So
there's a story here that you can fit together.
Absolutely. So obviously you have in India and in China some of the leading consumers of crude, and in the case of China, the largest consumer of imported crude. So when you look at that and you say, okay, for 3 years, you couldn't see their demand in global numbers, And they were buying at deep discount because beggars can't be choosers, and Russia had to sell something to someone lest they fold and say, okay, well, we've lost this war. We just don't have the money to pay. And so because they needed that, we've had those huge buyers basically not really reflected accurately, or at least reflected in a diminished way, because, of course, markets will speculate to what that impact is, and asset prices will reflect that speculation, even if they can't see the buying and selling directly, because it's all happening bilaterally in yuan and under shadow of data not being published on exactly what any of it actually is. But nevertheless, you bring these huge buyers back to market in earnest, and their demand starts looking the way that it would look were they just buying on the open market, you're probably going to see some level of melt up reflected in crude just to show that occurring. And maybe that's what's already occurring in anticipation of the inauguration and the idea that, all this talk about ending the war quickly. In that Mar-a-Lago press conference that you mentioned, Chris, Trump was talking about he wants to meet with Putin, and they've already talked about it, and they're looking to do it early into the term. Maybe there's a grand bargain behind the curtain here somewhere. It's probably not going to be a good one for Ukraine, but what it might be is just a mechanical upshift in where supply and demand meet for oil.
Interesting, though, that India was, because Dubai, you would think maybe, I wonder if all of the sanctions bypass, like all of the sort of bypass, India is the biggest beneficiary of the war. The second biggest beneficiary of the war is Dubai. And then after that, you have Caracas, Venezuela, and Bangkok, and Istanbul.
But India is doing well because Russia's sending oil, India's refining it, selling it back to Europe at markup, which Europe used to pay for like at the third of a cost.
That's right.
UAE, and thinking about back to where we were in November having this discussion right after the election, if the war ends, do you think all those Russians, those businesses, those oligarchs, those criminals that keep their money stashed in Europe that's currently frozen, do you think they're going to keep their money in those European banks? Or are they going to move their money?
India loses, Dubai wins, Istanbul probably also wins. On capital flight, on Russian capital fleeing Europe, but
UAE
not going back to Russia. Dubai's a gangbusters.
Oh, yeah, and this has been a working thesis for the past 2 months, right? But sure. Turkey, after the fall of Syria, I don't think Putin and Erdogan are going to be on great terms, because it seems like Erdogan...
No, but the Moscow-Istanbul flights are one of the best flights it's like New York, Miami, and Istanbul's set up to just run money out of there. I mean, I know Dubai's better. Dubai is better, but Istanbul's closer.
And that convenience matters a lot. But we have, UAE, it's going just like the Russell chart. We talk about that longer-term Russell chart, Ilya, and we've mentioned that longer-term bottoming process that was going on here in 2022 and 23 that we finally broke out of in 24. That chart feels the same for UAE, where it's just breaking out right now. In any event, you can fit together the pieces of the macro story here. There's an expectation the war is going to end. The tariffs are coming, right? We're going to have higher structural inflation. Europe's probably in trouble to a certain degree. Even our European equity markets here, if we think about this broad macro story, they're up a little bit today, but not until they gap open lower. So they're open, they're up from where they open, but not exactly on the full close. This just looks like a bear flag after a pretty big decline down here. I don't know. It feels toppy in these markets right now, but this is a hell of a turnaround today. Ilya, being more than 3% away from the 1 month moving average, it got a little bit long in the tooth to sell off. Mm-hmm. Tomorrow, thinking ahead now, if this is an area where the market bounces, what are we looking to later this week that we should be thinking about as a catalyst to avoid or place trades on the other side of? Because I feel like the calendar starting Wednesday has some pretty important data for the U.S.
Absolutely. I don't think you trust the veracity of any bounce here, um, unless it survives Wednesday, and that's really key. I think the bogey here, if you look at the uh, March contract for ES, looks like it's about 5,900, maybe all the way up to 6,000, but really 5,900, which is the bottom on the sort of mid-December range. So that's about as deep as that kind of former area of support become resistance gets, give or take. So 59, 15, 59, 20, something like this, maybe even 59, 30. That seems like a kind of line in the sand. I would not be surprised in the slightest if we come and test those levels over the course of the next day and then get stuck right around there as we go into CPI. I think the risk is asymmetric in the sense that if CPI is hot, you probably get more stock weakness. You probably get more of a upswell in rates, but you've already so departed what the Fed is forecasting on baseline expectations that it seems like if CPI were to surprise soft, that would be a more reactive thing than if it surprised hot. And so we're going to have to see. If there is no surprise and we have to basically punt this thing forward, the next inflection point is the retail sales report on Thursday. And these things come back to back. Tomorrow, by the way, the producer price index is getting published. Unless that's a wild surprise, people probably wait for CPI to really make up their mind. But there's a quick succession of numbers here. Tomorrow, Wednesday, Thursday, that are going to be very relevant. And I can see stocks bouncing into Wednesday and then being back on their lows by week's end, unless that CPI number is softer than expected. And if it is, then you can get some real topside reactivity.
Dylan, on Wednesday, the market is pricing in over the next 2 days that we could potentially see a swing all up towards 59.90 or perhaps as low as 57.70. This is a pretty wide range. The last few CPI reports were talking about, the potential for like 45, 50 points priced in 2 days out. So the fact that we're at 75 here does mean the market is expecting something to come of this. Ilya, if our technical threshold that we talked about on Futures Power Hours still valid, at least from the bullish perspective, it would really mean that you want to see some action above the 1 month moving average from here. Now, if the expected move through Wednesday,
such thing.
Right, like we'll call it 59.90 is where the expected move is. The 1 month moving average closes today at 59.91. So it's entirely possible, as I'm thinking about how this week's going to unfold, it's entirely possible the next day or two we get a rally back up towards a place where you say, oh, wow, bears are in trouble. We're nearly 200 points off the lows. And yet technically, the conditions still aren't met for bulls to feel comfortable yet. We could get back to the 1 month moving average. We could just trade within the daily range that's expected through CPI. And we actually aren't out of the woods still. We're still very much in the confines of, is this a triangle? Is this a head and shoulders pattern? Is it continuation or is it topping? And right now, I think you have to say it favors topping. I don't think that's difficult to imagine, right? Tweeted that last week. We've been talking about it. Looks toppish. Is it worth deploying capital again? Not putting any new trades on. I have legacy old out of the money calls on. So if they expire worthless, so be it. Here, though, it doesn't feel like there's much to do about anything. Tomorrow is PPI. There's a treasury auction calendar for this week that is barren in terms of market moving things. There are a few bills to go out, but no notes, no bonds that we care of. The earnings calendar begins to pick up over the next few days. We're going to turn our attention to what our friends over at the, which When are you in? Here? No. Here. Here. We're going to turn our attention to what our friends in the NASDAQ have to say. Tomorrow's earnings, nothing really important. $1.8 billion high market cap. It's really Wednesday when we kick things off. We're going to get the banks coming out this week. We're going to get some of the semiconductor companies, TSMC reports on Thursday. Dylan, can the banks be the catalyst this week to help pep everyone's spirits? From all indications, the banks have been printing money in recent quarters.
I think the answer is yes. I actually think the answer is yes. I think that a stronger economy, I think the rate situation, and I think the Trump administration is all good for banks, actually. And I think that's why Jamie Dimon was out blathering onto Leslie Stahl on 60 Minutes.
Doesn't it say a lot that banks, sorry to interrupt you, but every other sector has retraced the entire Trump bump after the election? Not banks. Banks are holding the gains. They're still the leader. That resiliency means something. Should it not?
I totally know. I have the same exact thought process, which is that Trump will be good for the banks, even though the bankers and Trump are oil and water in New York culturally. Because, no one condescended and looked down upon Donald Trump more than the elite bankers of Manhattan over, 50 years. But I think in this administration, they're actually going to be quite well aligned, because I think Trump wants a strong financial sector above all else.
Well, if you think about the whole thing being inflationary, right? The Trump trade being fundamentally inflationary and the markets being afraid of that, whose margins are getting padded if rates stay higher because things are inflationary? The banks. So the banks actually do okay in a higher rates environment. They get to make more money. They get to make a bigger spread. It's everybody else that ends up getting hurt.
Yeah, Dylan, you mentioned the oil and water thing. I think people who are from the New York area have worked around here. Trump's an outer borough guy, and inner borough bankers look down upon outer borough people. So there is that.
Maybe they do, maybe they don't, but
they definitely do.
They definitely look down on Donald Trump, wherever he may be from.
But the banks have been the people who have been a little bit cozier to Trump before all these other executives started lining up and putting money into the till. The banking sector the financial sector has provided the Trump administration a good deal of, the constituents. The Treasury Secretary, Commerce Department, Lutnick and Bessent, not respectively, in opposite order. But you got to figure, if you're stocking your cabinet with Wall Street guys and people from the banking sector, they're probably going to be, helpful to the banking sector. So 47.66 here on XLF. It's a 72.5 IVR, and this is a pretty liquid ETF. Dylan, if there was a place to look to sell some put spreads here this week, I think this would be it. Obviously, if we're going to do selling put spreads, I prefer to give us a little bit more time so we have some intrinsic value. But going 39 days out and looking, say, short put vert here, just under current prices, 61%, 62% probability of profit. Not the sexiest risk to reward, of course, but the turn is maybe happening right now. And you have this whole slate of earnings this week. We're given everything that we've heard from all these companies. If it's a JP Morgan, if it's a Wells Fargo, if it's a BlackRock, the economy's doing well. Delinquencies are still at a level that's manageable and not impairing their balance sheets or hurting their revenues. Banks should definitely be on play this week. It's not really a futures market, which we talk about, Ilya, but nevertheless, if the banking system is healthy and growing, that is early type of innings bull market activity that you'd like to see. Before we close out this session, Dylan, you were mentioning the wildfires earlier. Is this a black swan event for the market? You're talking about $175 to $250 billion worth of damage so far. There's another round of strong winds expected to come through the LA County area over the next few days. Tonight, they're looking at wind gusts up to 75, 80 miles per hour in some places. So to suggest that this is over yet, while many of these fires are 10, 15, 20% contained, we're not out of the woods by any stretch of the imagination. Is this the type of thing that could become the trigger where these utility companies, if they go under, and property and casualty insurance companies, they go under, it puts a strain on the banking system? The Fed's forced to intervene. The federal government's forced to intervene. What are you thinking about with the wildfires and the impact on the economy?
I think I would have a hard time getting where you just went just because of the too big to fail and the money printer. Like there is never going to be a risk to the financial system ever again, other than inflation and a collapse of the currency at some abstract future point. But like, I'm more thinking along the lines of materials inflation, the more linear. One, I think that there will be a restructuring in property casualty. Two, you would think there'll be a repricing of California real estate as a general thing, which could have, some of the, I don't know if the Golden West, who the big sort of debt financier is to California housing, but you could see in a case where a significant increase in property and casualty insurance prices in California, which is obviously going to happen, can result in a reduction of the price per square foot for California real estate. So there's definitely something there, and there's definitely something on the material side, lumber prices. I mean, obviously they got to rebuild an entire, 1/3 of a meaningful percentage of that city, but with not just the Palisades, but Altadena. I mean, it's ongoing. It is a remarkable. The destruction is incomprehensible. In terms of just the scope is so much of it. It's just something else.
Yeah, I just flashed a few tickers across the screen for people to keep an eye on, because if you're looking for any semblance of what's going on in these markets and whether or not the risk persists, right? If you don't trust weather.com and you don't believe the news reports, I think the financial markets are telling you what you need to be listening to. 4 companies: PG&E Corporation, PCG, Sempra Energy, SRE, Edison International, EIX, NextEra Energy, NEE. PCG provides gas and electric to about 2/3 of California, but Northern California. EIX operates Southern California Edison, which is why its share prices are down 12% today, and it's been harmed arguably more than the others. NextEra is a Florida company, but that has operations in California. And then Sempra is more about energy infrastructure than anything else, rather than being the provider of the electricity. These companies are still under a great deal of stress. And so I would just caution that people who are looking at this situation in the way that they look at any other spike in vol, you have to place this in more of like a Boeing UNH type of basket or approach, rather than being the simple, well, IVR is at 100, so I'm going to just sell some puts. There's clearly some fundamental binary event risk here that's making its way through the market, and trying to time it out while it's an ongoing event, difficult, if not impossible. I know people want to try to be cold and calculating and dispassionate about it all, but this is still running its course. So,
but are you suggesting that these stock prices are a reflection of the fact that it's an ongoing dynamic crisis? Or are you just suggesting that that it's a meaningful and material crisis? Both. Meaning specifically these charts. Both.
Like PCG, why on earth would PCG be down this much? They have nothing to do with this. Of course, it's just related risk. If power lines are swaying and bumping into each other and knocking bits of molten metal onto the ground in Southern California, who's to say that it can't happen in Northern California, given what we've seen in recent years?
Sure. Right? I mean, the fire hurricane is like a thing that now happens. Apparently, we saw it in Maui.
Well, Northern California is a little bit.
It should be different. You would think so.
I mean, listen, I've spent a lot of time in the. Anyway, we don't. The point is, the fire hurricane.
As a resident of Northern California, I can tell you that obviously we've had fires, and those fires have been significant, but they've been somewhat different. I would say that the closest version of what's going on in LA right now to what's happened in Northern California was the Santa Rosa fires.
Was that the Paradise fire? Was that Paradise?
I think that's Campfire.
Campfire was further north. The issue in Santa Rosa was that it was an urban fire, as opposed
I see.
as opposed
But I mean,
to
for me, the notable characteristic is the 100-mile-an-hour wind fire.
right. And so there's been a lot of writing now over the weekend saying, take a look at these pictures from LA and notice that you have structures burning and foliage standing next to it not burning. This is not about wildfires. This is not about the trees catching fire. This is an urban fire. And in Northern California, most fires have been not that, although easily the scariest looking one was back in, if memory serves, 2021, the Santa Rosa fire, which basically wiped the city off the map.
Yeah, I was up in Kenmare a few years ago, and then the year after we traveled through Napa, a fire came and like wiped out the bed and breakfast that we stayed at.
Yeah, so they've rebuilt, thankfully, quite a lot of that. But
I know, but there's a bigger. I just think there's a bigger issue.
Like
this is different. This is different than all those other fires for all the reasons that are obvious. But I think that the biggest market risk is that finally a fire will force a repricing of property and casualty insurance permanently higher and blow apart the California regulatory infrastructure that was trying to cap that. So the California regulators were trying to cap property and casualty insurance as a way to protect California real estate values. Understandable motivations. Obviously, that property and casualty insurance cap will not sustain. And as a result, real estate's going to get repriced.
It needs to be repriced.
But remember, no matter what you think it is, because you're like, oh, I'd never live in the fire. When you reduce the housing inventory, housing costs go up. It doesn't matter. Full stop. Like New Orleans after Katrina was a war zone, but the housing that was left in New Orleans was more expensive after Katrina than it was before. And it's going to be the same thing in California.
And as Ilya can attest to, people are going to have to make their way through the California Coastal Commission, which is just a lovely bureaucratic institution. But we'll have to cover that.
Or this
so many things to say about the Coastal Commission.
Listen, here, this is. I mean, I'll leave you with this. I know overtime's out of time. That's fine. Donald Trump, in his speech next Monday, is going to announce Trumpland as the new real estate development for all of Western Los Angeles, built in the vision of Donald Trump himself. You heard it here first.
Well, Dylan said it best. Overtime is out of time. We'll be back tomorrow. Same time, same place. 4 p.m. Eastern, 3 Central, always after last call. So for Dylan Radigan and Ilya Spivak, I've been Chris Vecchio. Good luck trading tomorrow. We'll see you there, though. After a brief break, Tasty Live's coming back at night. Ilya Spivak's here to take you with macro money. See you there.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Forbes called us best online for options trading. With stockbrokers.com, we're number one for options and futures trading. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
When you've got a futures contract that's in contango, what does that mean?
Futures, unlike stocks, have multiple prices appropriated to them. That's known as the forward curve. So when a futures forward curve is in contango, that means that the front month is trading cheaper than the corresponding futures back month. So you'd see that forward curve most likely looking like this in terms of prices.
And backwardation, what does that mean for futures contracts?
Backwardation is the opposite of contango. So where contango front month futures contracts are trading cheaper than the back months, backwardation is the opposite. So those front month futures contracts are trading richer than the corresponding back month contracts.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, four large, 4K, $4,000. Get on the platform for traders who just want to trade. Tasty Trade. Make your move. Forbes called us best online for options trading. With stockbrokers.com, we're number one for options and futures trading. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
The markets take a little bit of a breather on Monday after last week's brutal bloodletting. Are they going to find their way to yet another bounce, or are we looking at something that is more painful yet to come? That's the question we're going to wrestle with here today on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And what we are going to do here is take a look at what happened last week, just briefly to anchor ourselves in the backdrop, and then consider what comes next. And shock of shocks, it's all about inflation and what it means for interest rates. Some big data coming across the wires this week, not only out of the U.S., but also elsewhere. So let's take a look at first what last week was all about. We can see here stocks having a nasty one, S&P down 2.1%, NASDAQ down 2.3%. Surging interest rates across the curve, and the curve steepening actually as the long end outperforms. The 10-year up 3.5%, the 2-year rate up 2.3%. So higher interest rates all around, but the front end having a smaller move than the back end, and so the curve growing steeper. Crude oil seemingly of its own mind, still up 3.5% after the prior week's 4.8% rise. Of course, it's a little stronger again here today. Unlike gold, which managed, despite rising yields, which typically amounts to kryptonite for gold since it yields nothing, still managing a little bit of an upturn last week, up 2.3%, but it is now very much giving away a lot of those gains just at the start of the week. The dollar stronger against the euro, stronger against the yen. But interestingly, the yen actually holds up much better once we get to the end of the week last week. It's down on the week on the whole, but the overall story is much more supportive as that risk aversion bites on Friday. Bitcoin certainly looking like an amplified version of that risk aversion, which basically gives it double the loss of the S&P. And the weakness here is very easily traceable to two pieces of economic data, which ultimately tell us the Fed is not going to cut rates as much as markets might have hoped. We get in the middle of the week the ISM services report that covers the lion's share of what drives growth for the U.S. economy, and those numbers are white hot. The rebound in overall activity sharper than expected, but the real standout is the jump in the prices component. That, of course, is where inflation lives in the U.S. at this point. It's all locked up in the service sector, as we'll see momentarily. And that ISM services report gives us a story that suggests that service sector inflation isn't going very far except to keep pushing higher. Because what we end up with there is the strongest price growth reading since February of 2023. And so the markets look at that and say, okay, well, this is not exactly an environment in which the Fed can cut rates. We then, on Friday, after a brief break midweek for the market holiday linked to Jimmy Carter's funeral, former U.S. President Jimmy Carter, of course, we then get the U.S. jobs report, and there we end up with stronger results. 256,000 jobs added against expectations for 160. So we beat by almost 100,000 jobs. The unemployment rate unexpectedly comes down from 4.2 to 4.1%. And then at the same time, we get a solid number set for consumer confidence from the University of Michigan. Interesting bit there. Again, inflation expectations. The 1 year forward inflation forecast from consumers polled for that survey up to 3.3%, the highest since May of last year, unexpectedly, from just 2.8%. So inflation expectations surging all around, that diluting how much the Fed could possibly be seen to cut this year. And of course, against that backdrop, yields rise. What's interesting here is that whereas at the tail end of last year, we were getting interest rates rising, and indeed, we've seen this story develop since mid-September. We talked about this at length. Here's the bottom in interest rate expectations, or as it were, the most dovish setting, the most number of rate cuts being expected over this year and next. That's mid-September when the Fed makes its move to actually begin cutting rates. We can see they shortly after this bottom start their easing cycle. And as they do, and the economy appears to be hotter than expected, the markets say, okay, well, you're cutting into an economy that doesn't so much need stimulus. What you're going to end up with is reflation, and you're going to end up having to do fewer cuts in 2025 and 2026. So we see this tally diminish. And of course, now we're looking at just 46 basis points in all. One cut now baked in for this year, another one all but expected for next year. And here, by the way, is last week's pop in these expectations. So from here to here, and that's the influence of that hot economic data. So the market's now looking at all of this. They've, of course, been doing this process for a while, but last week it got more juice. And whereas stocks were moving to record highs, at least, let's say, September, October, November, as this process was occurring, Last week, the first full week of 2025, we very clearly saw not that. So it seems like yields have gotten to a level of pain where now higher economic data doesn't necessarily mean good news, because now the markets aren't looking at that and saying, oh, goody, the economy is growing faster. Now they're looking at it and saying, oh, no, rates will be higher and we don't need the cost of money higher this year. So this is where we find ourselves. And if we look at how these rate cuts are expected to work themselves out here, we can see the median rate 4.38 now. And if we follow along to what would look like a rate cut from this level, essentially the underside here is 4.25. 4.38 is a median that exists between the current setting of Fed policy, 4.25 to 4.5. And if we subtract from it one rate cut, that gives us 4.13. So we end up with one cut somewhere in the early second half of the year. So July, September, somewhere. And that's what we have for the year. Notice the terminal rate now north of 4%, whereas in September, when the Fed started the easing cycle, that would be here. Of course, we saw this adjustment that matches up with this adjustment here. We were looking sub 3. That's the backdrop. Now, what of this week? Well, we're going to get the relevant data here, needless to say, by way of the CPI report. This will be December's numbers. And as we were saying earlier, we can see that all of inflation, for the most part, now lives in core services. That's services minus energy and food. We can see goods inflation still slightly negative here. Energy inflation, likewise negative. They're actually deflationary forces here. And food inflation is basically a negligible contributor at this point. If we look at what this actually amounts to in practical terms here, of the 2.7% headline inflation recorded in November, 2.64 percentage points was services. Energy was a negative 21 basis point influence. Goods was a negative 12 basis point influence. Food a positive 30 basis point influence. So it really is all about services here. And needless to say, what we've learned last week is that were these numbers to be hotter, the markets now seem to think this is bad news, because that would mean that the Fed is pressured even further to dilute rate cut expectations. And so with that hot ISM number conveniently out last week, we take a look at how service sector inflation dynamics have played so far. And we can see that that service sector prices component, that's this right here. Here's that surge to the highest level since February of 2023. You can see that right here. And you can see that both the headline measures of inflation in the U.S., CPI and the PCE index, lagged about 2 months to this ISM prices component, lines up quite well. And so what that ISM prices component seems to anticipate then is we are now biased higher on prices, and CPI is about 2 months behind. And so the next step is at least somewhat tipped to be pointing upward. And so this narrow reflation that we've started to see here, probably not over, taking this at face value. Moreover, the direction of U.S. economic data relative to forecasts seems to have shifted after undergoing something of a correction. From mid-November, we can see the data started to cool relative to forecasts, looking at this index from Citigroup that measures relative performance. But now, with last week's NFP numbers, with last week's ISM numbers, we've once again seemingly started to reaccelerate and tellingly moved through the 20-day moving average on this. Now, as we've explained before, we're not doing technical analysis on an economic index. What we're doing is looking at a monthly average, and there's about 20 days in a month of this data, 5 working days a week, 4 weeks, give or take. And economic data tends to be released on a monthly cycle, most of it. Some of it is quarterly, some of it is weekly, but most important economic data is released monthly. And so when you go through the monthly average here, you get the sense that there's been enough data released for the monthly cycle to tell analysts your models are wrong, you need to update them. And if you see this kind of thing, that might very well inspire that model revision. We've seen that when you move through that moving average, be it here or here or here or here or here or there, you tend to see points of follow through. Not always. Sometimes you get false starts, but you do get a sense that perhaps now U.S. economic data is once again entering a cycle where it's going to be outperforming relative to expectations. Along with the ISM foreshadowing here, that may set the stage for hotter CPI. And of course, were that to happen, we probably get more of an upswell in yields, and that probably doesn't sit well with stock markets if last week is any indication. It's the same story when we get to U.S. retail sales data. That's due on Thursday. Expectation is for a 0.5% rise, and that would be a slight down step from the 0.7% in the prior month. But again, the risk here is, at least for stock markets, that the numbers come out hotter. That further emboldens hawkish speculative forces in rates markets and ultimately hurts stocks. Shifting focus across the Atlantic, the UK gives us the other big narrative for this week. They are also reporting inflation data. Here we're looking to remain unchanged at the headline, 2.6%, which is a three-month high for a second consecutive month, but the core reading just a touch lower, from 3.5 down to 3.4%. It's a bit of a different story here, though, in the sense that where U.S. economic data seems to have marked a little bit of an upturn relative to expectations, in the U.K., you're still very much underwater. This is the U.K. Surprise Index, and you can see here's the zero line where forecasts and realized results are in agreement, and we're well below that here, deeply into negative territory, suggesting that the surprise risk here is tilted to the downside. Now, because the U.S. and the Fed are such heavy weights in setting global interest rates, we can see that just as the situation in the U.S. corrected to a higher rate structure, so too the situation in the U.K. shifted. You can see again, from about the middle of September, where we had the most dovish outlook, 173 basis points in cuts, we've now shifted to about 50, and that's over the course of this year and next, although you can see for next year, the forecast currently calls for essentially no action. All of that 50 basis points here almost is being baked out for 2025. But as we can see here, the turn is very much in line with this turn that you see on the U.S. side. And it's because the Fed is the steward of the U.S. dollar, and according to the Bank of International Settlements, close to 80% plus of global monetary transactions are settled in dollars. So much so that even when, let's say, two countries want to transact bilaterally, it is actually cheaper to transact from one currency into the dollar and from the dollar into the third currency because the dollar is so liquid that the transaction costs are lower. So overwhelmingly, the dollar settles global monetary transaction volumes, let's put it that way, and is the premier vehicle for getting economic activity settled. So when you get a rise in the cost of borrowing dollars, as is implied by this shift in the Fed outlook, you likewise get knock-on effects everywhere else. In the UK, this has come alongside with their own sort of upswing in inflation over recent months. But of course, that has clashed with an economy that seems to be cooling. The recent PMI data suggesting that growth in the UK is coming down. And indeed, we'll see what the monthly GDP indicator gives us this go round. It is on the menu for this week, and it is expected to show us, at least in relative terms, what we might expect downwind from the more important quarterly numbers. The expectation here that we are going to end up with a 3-month GDP growth average at 0.1%, but in month-on-month terms, at least, that we are going to return to growth, that output is going to expand for November at 0.2%. That's after 2 months of 0.1% declines in September and October. So maybe a slight bit of positive news. But given the way this is set up now, and the shift that's occurred in the rate structure, as we can see, this looks almost identical to what we see from the U.S. Here's the structure in the U.S. September's curve already by November, by early November, giving us a much more hawkish reading as the markets interpret the Fed to be too dovish for the economy. And something very similar, of course, happened in the UK. Here we've gone from 3.4 as the terminal rate for the year to now 4.25. So if we take a look at what the 50 basis points that are implied here would look like, we go from 4.75 first here to about 4.5. So we get one cut somewhere in the first half. We can see it's loosely being baked in by March here. And then the next one to 4.25 gets stretched all the way out until the end of the year. And maybe you arrive there almost about 3 basis points shy. Indeed, it's exactly 3 because, as you can see here, this is 47 and not 50. So the risk here becomes, if the CPI data, and indeed to some extent the GDP data, comes in softer than expected in line with this, then you have some rethinking to do on just how much easing the Bank of England might be doing. And this tally might push out further. Now, where this becomes interesting is, of course, for the British pound. It's a question of how much lower does it go, and does this surprise significantly to push it lower still? Because, of course, the pound has been absolutely trashed in recent weeks. It's come down very, very sharply, and just over the past 24 hours touched the lowest level since late October 2023. It's also sitting on significant lows from right around then. The October 2023 congestion range was a big area of bottoming for the pound after a very significant sell-off from July of that year. Since then, the pound rallied all the way through September of 2024, basically a year's worth of gains until this rethink on U.S. rates that we've just looked at and that we're currently looking at in indirect form in UK futures started to really drive the dollar up right alongside yields. So if we're going to see some sort of a response here, some sort of restructuring of the outlook to a more dovish setting, the really interesting thing here would be whether the pound signals that this has already been anticipated and rallies despite the reshuffle. In other words, if this curve starts to move lower here and the pound doesn't fall further, there could be a very compelling bottom starting to take shape there. And that is Macro Money for today. As ever, we are here every Monday through Thursday, right after overtime, show that I co-host with Dylan Ranigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise on with Chris for Futures Power Hour, Mondays and Fridays, on with Victor Jones for The Price of Truth on Tuesdays, that's tomorrow, on with Victor and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're checking us out on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.
To my trusted financial advisor, let me know your thoughts on reinvesting what very little remains of my money into ramen noodle stock, now that I'll be eating it for every meal until I die. Best, Cynthia.
Sometimes it feels good to get smart. Get even smarter with live market insights and insults.
They're all frickin' losers. There's no skill.
From the smart mouths at tastylive.
If you missed the live show, here's our cherry on top yearly recap.
So, we're doing the show on Friday, and the bat, he's doing the show in the morning, then he's going away afterwards, right?
Yeah.
He's all packing up the car, he's doing his stuff.
RV.
Packing up the
Packed
RV.
up the RV for a 6 to 8 day trip. We're supposed to be there about
4
48
days.
hours.
I bet him $20, and I said, you'll be in a hotel by either the first night or second night.
Oh, and then I vociferously stood up for you.
Of course you did. You should have, because that was the smart move.
I appreciate you. You're
yeah.
Good.
Saturday morning, I look at my phone, and it says Venmo, $20.
Now, when you're on air, you're like looking at this. You need some help.
Nope, I got everything fine. The problem is I just have a lot to do. You see, because in your job,
oh, here we go.
Really, all you have to do.
Get the full scoop by checking out the archives at tastylive.com.
Got the need for speed? No problem. At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace. With me today, it's Monday, of course. Katie McGarrigle. What is it? Zadie
McGarrigus.
McGarrigus.
Yeah, party up. DMX, RIP.
Yeah, we're bringing the noise to start this one. It's not really the DMX song, though. It's just a whistle. It's like this annoying whistle. We need
It's good.
a longer intro.
Yeah.
Give me like a minute and a half to get warmed up a little bit.
A minute and a half.
A little bit.
We'll see the chat start to drop off. Speaking of, what up, chat?
Yes, you saved us there. What up, chat? Go over to YouTube, stream it over there. No shade on Tasty Trade. There's just no live chat. You don't have to participate, but come on.
I know. Well, we've gotten, when we first started to stream on YouTube, I had the profound joy of moderating a lot of it. And back in the day, the bots were coming in way too hot.
Okay.
Way too many gross and wrong things to say. We've since cleaned it up. So yeah, and we're seeing a lot of new people joining us in the new year. So welcome if you're new, welcome if you're old.
Yeah,
Happy to have ya.
Big Deal Donuts, Grumpy Mike, Jason Tatum, Night Moves, Gapper,
I'll also
Sophos.
So I'll also give a shout out, and I don't know if he watches this show, but I got a homie that goes to the same gym as me, and he's always in there grinding, doing the workouts. So shout out to Desmond if you're watching.
Oh yeah. Speaking of the gym, I can barely see this. Lone Sophos, is that like just a picture of a six-pack there? What we got going on in the chat?
Oh yeah,
Is it like a locker room shot?
Like it, yeah,
I like that.
It's like a little bit of a thirst trap.
I'm all for that here on the Tasty Crypto Show.
You're pro thirst trap.
Yeah, we're pro thirst trap here. Absolutely.
All right.
Katie, what do you want to know today? We've got everybody over here. Type something crazy in the chat. Say hi to Katie. What do you want to know?
Man, that is a great question that I am completely panicking on.
Go anywhere. We're asking people whether they're pro gun lobby, what they're wearing for Halloween, their feelings on you name it. What do you want to know?
Well, based on the conversation I was having with you and some of the other boys, are you pro bills
Oh, okay.
or anti?
Yeah, there are some haters out there.
I know.
Calling Josh Allen overrated.
I think that by default in this office, even, obviously the Bears did what they did, so I have to now, support the Bills, but give us a shout. You're pro Bills or not?
Yeah, my wife is a Ravens fan. She's from the area originally. They're looking pretty good.
Okay.
Not going to lie, Ravens looking pretty good, obviously.
You guys going to have like a massive banger of a party?
No, we might have a fight.
Oh, okay. You're going to have to squat up.
Yeah, no plans yet. If I have a party, though, I'll let you know. You're
Thank
100%.
We're within shuffling distance of each other. Not to dox us, but...
Yeah, that's right. We live in the same general vicinity of this big city.
Of this major metropolitan area.
Well, Katie...
You want to know anything? Is there anything you want to throw in the chat?
Yeah, I guess let's stick with the football theme. Who do we have winning the Super Bowl out of all the teams left? Let's see where everybody's at.
Who's left now?
There's a lot of teams left. AFC, Houston, Kansas City, Buffalo, Baltimore. We've got a game tonight. Who plays tonight? Chargers and Vikings.
Okay. I mean, honestly, I'm just going to keep going with the Bills.
Okay.
You guys have been hurt in the past, and I think that this whole office, or at least, the portion of the office that is from the Buffalo area, will absolutely lose their minds if it happens, and I would love to see that for you because we can't have it. So I want to see
not yet,
joy.
It's not this year.
Not this
It's always
year.
next year.
There's always next year. Yeah, but I want to see you shine.
Well, I
So go
appreciate
Bills.
that. Yeah. It's nice of you. We got some Ravens fans, Lions, Vikings, everybody everywhere. And yes, we do need a thirst trap token. I'd like that. Katie, let's jump into the show though. We can go anywhere. We've titled this one DeFi and Liquidity Pools. When we were doing Where Do I Start, we hit on DeFi, that concept, and I think that we demoed liquidity pools or talked about it briefly at the end of this series. We can continue there, jump into it right away. We can talk about price action in the market, big bounce here into the end of, I guess, the traditional trading hours when you look at the equity market. Bitcoin back up to 94,000. We could talk bag battles.
So many places to go.
Where do you want to go first?
Okay, let's start with just like a quick recap of where we are, because to your point, and to Shelly saying earlier, who's the winner of the bag battles this week anyways, like things were looking all right-ish last week, and then they kind of rolled over. So talk me through like what you're thinking and what is happening.
In terms of your specific token and bag battles,
mostly
or
just
the
in
broader
terms of
market?
The asset class as a whole.
Absolutely. No, I'm just kidding with you. I think you made
In terms of Harry Potter, Obama, Sonic 10.
fantastic choice, obviously. Yeah, let's take a look at what's going on here. So we've had a bit of bearish momentum. I mean, if you look at kind of how we ended the year, it was on a little bit of a weak note. The first couple of weeks here into January, that's continued. If we look at right where we were, and I talked to the guys on OTCL, Mike and Nick, about this earlier today, pretty much unchanged week over week. That was true up until an hour ago. So a little bit of a bounce here. But yeah, we've been chopping sideways, consolidating if you will, between that, let's call it 90 to 110,000 range.
Yeah.
Not much has changed on the volatility front. You can see still structurally bullish. I think the trend is still bullish in there. You can see that when you look at weekly or monthly momentum, 3-month price trend, Bitcoin up 43%. But over the last month, it's been a weak start, a soft start to the year. Interestingly, we've seen this before during the first year of a halving cycle, which is what we're in right now. That start to the new year, start to January, has seen some weakness, and then it's exploded thereafter.
Yeah.
I don't know. We'll see if that happens again this time.
Yeah.
But if you're worried about some of the volatility, I think this is just a short-lived period when you look at the equity market as well. We'll talk about correlations here in a second, or we can jump over to them really quickly, actually.
Yeah.
Strong positive correlation, very strong inverse correlation with the VIX. I think, again, if we get out of this period of volatility, let's see what happens. There could be some catalyst post-inauguration, executive orders related to crypto, related to SAB 121. Clearly, we have a new team coming in when you think about a new SEC commissioner. So there's a lot that could possibly act as a tailwind here. But again, a little bit of a weak start to the year. That said, really range-bound trading here. If we look at implied vol, not much has changed. Here are your volatility ranks. So on a 3-month basis, kind of middle of the range. Same thing when you look at the 6-month and 1-month period, or 1-year period, excuse me. Expected move for Bitcoin about 8,000, ETH 300. You've been on the show many times now, so this is pretty much where we've been for the last couple of months. Trading ranges, and again, the view here has been sell a little bit at the top of the range, buy a little bit back, recognize that the broader trend is bullish still. I try to stay on the right side of that. Doesn't mean that there can't be contrarian trades at times. If you're trading this from the short side, your opportunity to cover was at the bottom of the range earlier today. And then you've got, a bit of a bounce here. I think rinse and repeat. This has provided a lot of trading activity and opportunities on, both sides of that range. We've just been hanging out near the low end of the range recently.
Okay.
But again, nothing's changed. Here's your expected moves, $300 or so for ETH, about 8,000 for Bitcoin, Solana $20, and you can see the range for Doge as well.
Yeah. So we've definitely, since last week, seen a little bit of an expansion, obviously, in that range for Bitcoin in particular. But I love looking at it this way. Like I've said before, it just makes it so much more digestible to me as somebody that's still pretty new to the space to understand what I'm walking into, so to speak, when I power up my apps and platforms.
Yeah, I think it's helpful to put some context around the price action. These ranges are dynamic. We know that the spot price changes. The implied volatility is going to change as well. But it's a good guide, I think. Tougher when we look at Solana, Doge, and others because we don't have an implied volatility. So all we can go off of is that backward-looking realized vol. But if you understand the characteristics of what you're trading, it does make it a little bit slightly easier, I suppose.
Sure. All right. Well, good to know. And yeah, like you said, I'm very curious to see what happens as we go into next week. I might be looking to nibble on a little bit more, actually, now that I'm saying that. So we'll see.
Yeah.
Next week's going to be a big one.
I think so, too. I'm bullish as of right now. I have no signals or indicators that would make me feel any differently. Clearly things can change and we can change our minds. But yeah, again, sideways consolidation after just that absolute ramp. I think the high in there is 108,000. We breached 90 today. We traded down to 89, very quickly bid back up. So you're still within that 90 to call it 110 range. I think you trade there for now. I do think you see higher prices, but there will be a point in time where you want to sell. Is it 3 months from now, 6 months from now? We have to monitor the market. But this isn't something, in my opinion, where you just hold the entire position and only add to it and just pray that it's exactly. Maybe 2035, a decade from now, I don't know, $500,000 per Bitcoin, $1 million per Bitcoin. People love to dream, right? The reality, though, is if you see a further extension of this rally, you probably want to take some profits. It's not going to go up forever. There are pretty clear cycles here. I think it's still relatively early in the grand scheme of things, I do think that we'll see somewhat of an alt rally or kind of rotation into alts. ETH's just been destroyed versus Bitcoin if you look at that ratio. But again, post-halving, I still think we're still, early to mid cycle. So I'm less worried about some of the, the pullback or the correction that we've seen off of all-time highs.
Got it. Love it.
Yeah.
Thought-provoking, head-scratching.
So what are you in? We've gone through, where do I start? You're familiar with crypto. Do you have any existing positions?
I have a little bit of Bitcoin, a little bit of ETH, a little bit of Bonk,
Okay.
a little bit of Solana.
I like that. Bonk, kind of a levered Solana play. It's
Yeah.
like a Doge on Solana.
Yeah, and then, of course, we've got the bag battles. So I am looking to and eager to hear thoughts around expanding my horizons. Like you said, like there is a lot I still want to understand about liquidity pools, because that was such a thought-provoking thing for me when I was first like learning about it with you a couple of weeks ago. And I think I get the general idea and like the benefit of being a liquidity provider, right? But as I've said to you on and off the show, like the repetition piece is what's really gonna allow me to kind of stick to this. But I'm kind of in the big names, other than a couple of fun ones with you and the boys.
Okay. I think you're in the right place then. Personally, my portfolio is probably 80, 90% Bitcoin, ETH, Solana. More so today on those pullbacks, I'll add to the Solana position, I'll add to the ETH position, and some other alts. Have a pretty big Bitcoin position relative to the portfolio in terms of just the weighting.
Right.
So I'm not adding as much there. What I'll probably look for is when do I want to rotate out of that Bitcoin position and then into something else that could see better relative performance.
For sure.
If you believe that Bitcoin is a 2x, so just arbitrarily throw it out there, a 2x at these levels, where are the opportunities potentially for that 5x, for that 10x? And again, just throwing out
Right.
arbitrary numbers or returns, but I think that's the way that you should look at this as we get a little bit later in the cycle.
Sure. Yeah.
We'll look to Bitcoin market cap dominance to roll over there as one indicator. It's currently higher on the week by, almost 3%. So
I feel like it's almost one of those things like, and this has been the narrative for however many years now, right? But like you've got your mainstay investments in like big tech names. But as soon as something else comes on the scene that could be really breakthrough, maybe you peel off a little bit of your Apple or whatever, or Amazon or Google position, and you put it into something that's maybe a little bit more, has the propensity for more upside, I guess I would say, in a shorter time frame.
I think so. Yeah, I think you want to look for that rotation. That said, in my opinion, in my experience, the best trade here has really just been to hold throughout some of the volatility, add on those dips, and stick to what you know in those bigger, more liquid, larger market cap tokens. And it doesn't mean that Bitcoin or ETH or Solana are going to be the only three, but that's worked really well versus trying to chase some of these memes. As you've seen, they can go up 200%, 400%, whatever in a day or a week, and then they can go down 70% just as quickly. And so you can get chopped up there. And when you chase that FOMO sometimes, it's really not a very productive strategy versus just long and strong throughout the cycle. But again, there will be times where I think, even looking at those three, I want to be overweight Solana versus Bitcoin. And you can look at the ratio or the price chart, and when you see that Solana priced in Bitcoin is outperforming, or ETH priced in Bitcoin is really starting to outperform, we get some signals there, that again would be another box that you check where, okay, maybe we sell a little bit of Bitcoin here, we buy a little bit of ETH, we buy a little bit of Solana, that sort of thing.
Okay. Makes sense.
So all that said, Katie, let's jump into our discussion on DeFi on liquidity pools. Let me first ask you, do you have a crypto wallet, a self-custody wallet?
I do.
You do?
On Tasty Crypto.
Beautiful. Okay.
And I have a couple of other apps, of course, as you and I have started to rub elbows a little bit more on like the marketing of crypto in the Tasty ecosystem. But yes, I use the Tasty Crypto app.
Beautiful. That is step one. I've got a slide here that we can pop up. This is what the Tasty Crypto wallet looks like if everyone is not familiar with this. You don't have to use the Tasty Crypto wallet. Tasty Crypto wallet is just a front end for the wallet address that you control on the Bitcoin blockchain, Ethereum, layer 2 such as Base. We've got Optimism and Arbitrum that we just launched on. We just released an update to the app.
Nice.
I believe it was on Friday last week. And we're also on Solana. You'll need this to be able to connect to decentralized exchanges, to provide liquidity, to trade, to really be in control of your crypto on chain. This is referred to as a self-custody wallet or a non-custodial wallet versus when you're trading in your Tasty Trade account or your Coinbase account or wherever you trade crypto, that is a custodial exchange. You're not in control or you're not the owner of your crypto necessarily. And that sounds like a weird way to say it, but you don't actually have control of your private key, if that makes sense.
Yeah.
It's safe, it's in the bank, but you don't have the password or the code,
Right.
the combination, I suppose is the word I'm looking for, to the safe. Whereas you take it out of the bank, you put it in your safe at your house,
Yeah.
you have the
Your
combination.
shoebox.
Yeah. So kind of a weird analogy, but this is something where through this application, you can do a bit more with your crypto when you're in control of it.
For sure.
Versus trading it on an exchange. And there's nothing at all wrong with trading on an exchange. It's extremely convenient. It's what I do with most of my crypto. It's just that today, given kind of a lack of regulations in the space, at least in the US, most of these platforms, Tasty Trade included, just aren't able to give you the same kind of flexibility or present the same potential opportunities as you have when you go directly on chain and do it yourself through a self-custody wallet. So we've built an application to allow you to do that, even though it isn't necessarily with your Tasty Trade account.
Got it. And I mean, as you're kind of showing here, it's pretty simple, right? Like you just create a new wallet, you can figure out how you want to back it up, and then you just kind of move on.
Exactly. So you need the wallet, and then once you have the wallet, you need some crypto in the wallet. We'll help people with how to do that, but I think most people can figure it out. You can transfer from Tasty Trade, you can transfer from other exchanges, you buy the crypto, you move it to your wallet address. Very easy to do that. Once you're in control of it through your self-custody wallet, you can go and do really whatever you want with it on chain. You want to send it to somebody, you want to connect to a decentralized exchange, you want to stake it, the world is your oyster.
Got it.
The blockchain is your oyster, I
Can
suppose.
we pause there really quickly? Because like this is where, you know, if you can do it between wallets or between different apps, like I know that there's an element to fees, right? Like that comes with transferring of your crypto holdings. Is there a is there a gimme or a gotcha that you kind of need to like think about as you're doing that? Or is it just like everybody's relatively comparable in terms of the fee that they charge for transferring? Or
here's how I would think about this. It's actually related to the blockchain that you're using or the network that you're using. So we're on Ethereum, but are we on Ethereum layer 1, the base chain, I suppose, or are we on another layer 2, a scaling solution, something like Polygon, Optimism, Arbitrum, Base through Coinbase?
Yeah.
That's going to determine the fees that you pay.
And is layer 2 presumably more expensive?
Much, much cheaper.
Oh.
So these layer 2 networks, this is how I would think about it, I suppose. Bundle all the transactions together and then use the layer 1 as a settlement or security layer. So instead of all of these transactions settling on ETH separately and all paying a separate gas fee, you can bundle them all together and then pay one gas fee. So it's going to be much, much cheaper to transact on a layer 2 than it is on the layer 1 today, at least. So there could be some upgrades coming that change that, but that's how it stands today. So it's not so much like the provider or the wallet. When you think about what the wallet software is, it's just a front-end client. It's almost like an email application on your phone, where you could have Apple Mail, Gmail, Outlook, whatever, all connected to the same email address. Same thing here. You could have a bunch of different wallet applications. You could have Tasty Crypto, Coinbase Wallet, MetaMask. You can import the same seed phrase into all three of them, control the same address or the crypto on chain. It just depends on which interface you want to use. Maybe you like Tasty Crypto because it is the Tasty brand and it has different features you like. Or maybe you like MetaMask, whatever it might be. Your crypto is all on chain and you're controlling it with this front end. It doesn't really matter what front end you use. They all do the same thing.
Got it. Okay.
So there's no fee charged by the application there. It's all on the blockchain. And then it's what blockchain network am I using?
Okay, that makes sense.
Today, when I provide liquidity, I'm primarily providing liquidity on Uniswap, which we've talked about before, but on the Base network.
Right.
And it's much cheaper.
Coinbase app-ish.
No, not even
Or
so.
layer.
That's the other thing to understand. Completely detached from any application.
Okay.
So Coinbase as an exchange has used some software, I suppose, is the way that I would think about the Optimism stack, open source, and they've built their own Ethereum scaling solution, their own blockchain.
Okay.
So it's
But
from
you don't
Coinbase, the
need to
company,
have the
but you don't
Coinbase-
need, no, not at all. It's like, I guess, interacting with Solana or participating on another network. This network just was conceived by Coinbase.
Got it. Okay, that
But
makes
it
sense.
does a lot of the same things that all the other ones do. It's just much cheaper. So that's where I've been providing liquidity. But on the show, we've done this on Polygon. You can do it on Arbitrum, Optimism. Because it's Coinbase and they have such a large user base, they've been able to onboard more people through this mechanism. And that's where there's a lot of activity and volume. And so therefore, that's why I want to provide liquidity on that chain.
Yeah.
But that could change. All of a sudden there's a new use case over here. You have more users. So maybe you provide liquidity on Optimism. Today, I'm primarily on Base.
Okay. And I think I asked you this previously, but when you are providing that liquidity, there's no minimum time to provide that liquidity, correct?
There's not. Yeah.
But obviously you're rewarded for the longer that you're involved.
Yes.
Rewarded, I say with air quotes. But
So let's talk about what happens then when you're providing liquidity. And if we throw up the browser here, we can take a look at Uniswap. I know we've talked about Uniswap on some of the prior Where Do I Start shows. We've discussed how you can use Uniswap to swap tokens. It's a decentralized exchange. But on the other side of that, we've talked about where that liquidity comes from. And that liquidity comes from liquidity providers. So if there's liquidity in what's called a pool, you can swap one token for another. If there's no liquidity, well, you can't do that. So we've discussed that a little bit. But on the LP side or the pool side of it, where you provide liquidity, you're going in and, let me just connect our wallet here very quickly. So if you're on the Uniswap platform and you're using the Tasty Crypto wallet, you can do this within the mobile app. It's actually a lot easier to do that, but because we have the browser up, I'll just do it this way. What I'm going to do is now open up the Tasty Crypto app here, and we're going to connect the Uniswap application to the wallet here. We're going to establish that connection. So if I just go in here and I paste that code that I just copied from Uniswap, now we're connected. So now we can create a pool. And in order to do that, you have to click on pool, and then you have to click on new position. And now it's reading what I have on chain because I've established that connection. It really doesn't have anything to do with whether I use the Tasty Crypto browser extension or what app I'm using at this point. I've established the connection. So the Uniswap application here can read where I have various balances. Let's say that we want to do this on ETH, and I'm just showing you how this looks, or excuse me, we want to do this with ETH, but we want to do this on the Base network. So we have to have both, in this case, if we want to provide liquidity for Ethereum in a USDC pair, we have to have both.
Right.
But the point of all of this is that as you go through and you set this up, you can select the range that you want to provide liquidity within. So you asked, I think, to some degree, can you do this into perpetuity? The longer that you do this and the longer that the underlying price stays within the range where you're providing liquidity, you're going to generate more in fees. You're going to yield more off of your initial capital versus if I just did this for a couple of days.
Got it.
That said, it needs to stay
In that
within the
range.
training range. Yeah, it's kind of like a strangle, if you will.
Okay, yes, this is all coming back to me now. It's been a long couple of weeks, my friend.
I hear you there. What's happening here? Well, you're providing liquidity to facilitate the exchange of one token for another. Why would you do that? Well, you receive a portion of the fee that's charged by this protocol, that's charged by this application.
Some fraction of a basis point or something along
Yes. if I come in here and I want to use Uniswap to trade ETH for USDC, I want to sell my Ethereum for US dollar stablecoin. And I want to do that on the Base network or the Ethereum network or any of these other ETH layer 2s. I am going to pay a small fee. It's on the notional value of the transaction. And in most cases, we'll say it's going to be about 5 basis points.
Sure.
Well, that 5 basis points goes to the liquidity providers. So instead of it going to an exchange, like the CME or the CBOE or something, the New York Stock Exchange, or instead of it going to a brokerage firm like tastytrade, this goes to those people, the individuals or the institutions, whoever it is, that are providing liquidity. So if you are providing liquidity that helped to facilitate the exchange of these tokens and that fee was charged, you're going to receive a portion of that fee.
Got it.
And that's how you generate revenue or you generate yield by providing liquidity on a decentralized exchange.
Okay, that makes sense. I think of like when you go to Coinstar, dump all your coins in that damn bucket, and then they take a little bit off the top to give it back to you in cash. It's similar. It's not quite the same, but in the sense of you are exchanging, one tangible thing for another tangible thing, but you're not getting your exact full money's worth, right? Like that's kind of.
Well, in this case, I would think of it a little bit differently. It's almost like there's this large marketplace.
Okay.
And everyone is basically selling the same good, if that makes sense.
Yeah.
But you can show up to this marketplace with those goods. Let's say it's 2 different color t-shirts. One's a white t-shirt, one's a black t-shirt. Those are the only 2 things that you can buy at the marketplace. But as anybody can come in and set up a stand at the marketplace. When you set up a stand, you only have so many black t-shirts and so many white t-shirts. If everyone is buying a white t-shirt, in this case, they have to exchange a black t-shirt for it, you're not going to have any more white t-shirts left. If everyone is buying Ethereum and you start with a limited amount of Ethereum and a limited amount of US dollars, you end up selling out of all your Ethereum. You're collecting a fee each time someone buys some Ethereum.
Okay, yeah.
But you're ending up with only dollars at the end of it. So it's more like, you're a market maker in that sense, but it's more like a strangle where
Got it.
You don't have a defined fee that you're collecting when you sell premium, but you want it to stay within this range. And as long as it does, it'll work out for you and you generate those fees. But what you're giving up is really the opportunity cost.
Sure.
So let's say that the alternative is just to hold ETH and you're bullish on ETH. Well, if you're selling some of your ETH as it's going up, you're not going to have all that ETH that you would own at the ultimate price it lands at if it does continue to go higher. Similar to a covered call in that sense, where you're limiting your upside.
Sure. Okay.
It's just in this case, versus selling a call option and receiving premium, you have this constant market making activity that's happening automatically that's utilizing your capital that you've staked or you've deposited with this exchange. And every time that your capital is used, you get a little bit of the fee.
Okay.
If you want to pull your capital out at any point in time, you can do that. In some cases, you might pull your capital out. You'll have more than you started with plus your fees. If the prices go down, you might have less, but it could be offset by some of the fees.
Right. Okay. Makes sense.
Yeah, I know there's a lot there, and we kind of ran out of time in terms of showing how to set this all up, but it's a little bit into the concept of providing liquidity. One of the things that you can do with your crypto here through the wallet. We'll talk about this in more detail. And I think at some point, Katie, we'll get you set up where you'll be trading your own pool, or more so just creating your own pool and kind of watching the fees come in.
Yeah, we'll kick off the next one. We're going to be off for the market holiday next week. And I believe you're joining the show with Shelly on Wednesday. But
yes,
we'll get back in here soon, and we'll kick that off at like the top of the 4:30. Not really the hour, the next show.
Absolutely. Awesome. Well, let's do that. It's been good chatting with you. Thanks for coming on the show.
Thank you as always. And thank you, chat.
Thank you. Yeah. We will be back on Wednesday, like Katie mentioned, with Shelly. So stay tuned. And then, I guess we'll see Katie back here again in a couple weeks. But thank you again. Until then, I'm Ryan.
I'm Katie.
Peace.
Peace. Go Bills.
Looking for a better broker and a bonus? Sweet. We got you. Right now, you can get a bonus of up to $4,000 when you open and fund a Tasty Trade account. Plus, low rates, smart tech with the analysis tools you need, and award-winning support. So, get a broker who's actually got your back. And up to $4,000 at Tasty Trade. Make your move, genius. Tasty Trade.
Decision to build Thinkorswim was a byproduct or derivative of 20 years. In our minds, the future of finance meant that we were going to move away from something that was very manual and move to something that was tech-driven.
What we did with Thinkorswim truly changed the industry. To do it a second time was a challenge that I just had to take. The platform is just leaner, cleaner, a little meaner, legitimately built from scratch.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. That's what I do.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Get a bonus of up to $4,000 when you open and fund a Tasty Trade account. Make your move, genius. Tasty Trade.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, two female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
Decision to build Thinkorswim was a byproduct or derivative of 20 years. In our minds, the future of finance meant that we were going to move away from something that was very manual and move to something that was tech-driven.
What we did with Thinkorswim truly changed the industry. To do it a second time was a challenge that I just had to take. The platform is just leaner, cleaner, a little meaner, legitimately built from scratch.
Got the need for speed? No problem. At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
If you missed the live show, here's our cherry on top weekly recap.
You'd look good in either, you know what would good, like a nice Panama hat in the summer.
A Panama hat and a skirt? Oh my God. You look so sexy. I mean, you look like you just got out of bed, like you just
don't say it. No,
fingers through your hair.
If you missed the live show, here's our cherry on top weekly recap.
Put on your yarmulke. Here comes Hanukkah. So much Funica. Instead of one day of presents, we get 8 crazy nights.
I gotta tell you, that does look like a Tony Soprano tracksuit. Like you're getting a little.
He's all tracksuited up.
Right?
I was waiting for somebody to say something. And if I had pants on, then I would have the Sopranos tracksuit on, right?
I made burnt ends chili yesterday. Scott's never really had it, so I brought it in.
Today, so he can try it?
Yes, it's not hot, so yeah.
We have a microwave. Is it okay if we microwave it, or will
You
it
can
ruin
do
it?
whatever you want with it, yes.
It's very rare when you get an outbreak that you get to film the origin of it.
I brought you in chili.
Did you?
Yes.
He did. He brought you in chili. Nobody was allowed to touch it. Now
It's in their
been sitting
refrigerator.
out for hours.
Now I gotta talk about the chili. Here's my comment about the chili. You were right, not enough spice. They needed to be like, I don't know.
He doesn't chop his up enough.
Is that what it is? Yeah, it's like something was
you can
off.
chop him up a little finer.
And then maybe pan saute him for a little bit.
Yeah.
Not enough beans. And the tomato, what do you use? Like Hunt's tomato sauce or paste or something? Just throw it in there?
Oh my God.
I love you, Tom. Scott.
Checking out the archives at tastylive.com.
Got the need for speed? No problem! At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
Yeah, it is Tuesday, January 14th, a little bit after 5 p.m. or so, they tell me. You know what that means? It's time for Tasty Live's evening show, a little podcast. A little podcast called The Price of Truth, the show where we explore the incentives that govern our world, not just the prices on our screen. Shout out to everybody. What's going on? All of you watching on tastylive.com. Shout out to all of you watching directly on Tasty Trade desktop and mobile applications. If you don't already have both of them, I suggest the first part of your new year, new me plan is to go out and get both of them. However, if you're watching either of those three platforms or destinations, you might want to hop on over to the YouTube channel so you can participate in this cool little chat that's going to show up here. I think maybe we timed it well, maybe we didn't. But speaking of that YouTube chat, shout out to everybody in that YouTube chat. Shout out to you, Brian, Jason, Cato. I see so many others. Lone, Grumpy Mike, Victoria. I miss the bad trader stream, says Lone. I'm with you. I can't get enough of everything, Bad Trader. But shout out to everybody out there. I am streaming to you live and in direct effect through a VPN, by the way, because of interesting Indonesian security. I'm streaming to you from Bali, Indonesia. So I don't know if any of you happen to be near or around here. Hit me up on Twitter at Victor Jones, at Victor Jones, the Owen Jones, the zero, because I like to be difficult. I guess we should get started. By the way, if you're in the chat, just start pounding random ass characters. For whatever reason, Google doesn't really care what you say. As long as you start pounding your face into the keyboard, it will prioritize this stream and we'll get more people in here and we'll save the world one stream view at a time. My babies, we leaned into a potential reversal, not even a reversal. We faded that Santa Claus rally. I say we, I assume you guys are thinking like me. But that, you guys are much smarter than that. The point is, into the tail end of December, we haven't talked that much. Into the tail end of December, we were sort of fading that Santa Claus rally. And early in December, we took some pain, but surprise, surprise, the narrative was a bit overdone. And people now are starting to price some of the things that we've been talking about over the last, 3-4 weeks. It's always brutal. It's always brutal to have, the market makes you just, you think you know something? Okay, maybe you're right, but I'm going to test your intestinal fortitude. Let's see how much you believe. Let's see how much conviction you have in your ideas, Mr. Jones or Mr. Brian Watson or Mr. Cato, Mr. Lone Sofa. Let's see how much conviction you have in your position or in your risk management, in your logic. And we got put to the test early in December, but I think over the last couple of weeks, some of the things we were looking for, you could say hoping for, started to materialize. The question is, how far? How far do we start to see some correction? Is this all we get? Is this going to be all we get, or is this going to get a little bit uglier going forward? Are we going to see sideways slop and chop? We're going to see a downwards market to more than a 10% correction. I don't know the answer to that, but I suppose each day we're going to come here, we're going to explore that together and look for the best possible risk and reward bets. And I shouldn't promise that from my perspective, and I'm not sure sure how good my perspective is. The point, my babies, S&P 500 at 58.92, a little bit of a pause in the ugliness that we saw over the last couple of weeks, but that's not so strange either. Over the last couple of weeks, we've had 2, 3, 4-day rippers and into weakness, and we've continued to see lower lows and lower highs. Into what was that? It's not yesterday, Friday's session, basically coming in or no, I should say the open, coming in and tagging that 5,800. Pretty scary little day. I'm not going to say who it was, but a certain individual on mainstream financial television just was kind of a little bit of a scaredy cat this morning. That's how you know they were going to rally. But I think when you look at VIX and volatility, I'll talk about the NASDAQ, the Dow, and the Russell here. The interesting thing about the Dow, you've got a price-weighted average, which means it's going to move in its own total weird, funky way. But you also have a lower beta index of names, more blue chip stocks. So if volatility does hit, it has this weird sort of way of collecting assets as people downshift into lower beta or lower volatility assets. So you got a bit of outperformance in the Dow versus the other majors today. More on that in a bit. And we'll talk about the Russell here. But the point is, I want to start with the VIX, the volatility index at 19 and change, because I'm of two minds in the volatility index right now. I always hate those guys, on one hand and on the other. But I suppose I got to be honest. I do. Most of us, I think that way, though, right? The world is a distribution curve with probable outcomes within it. You've got a left tail with left tail outcomes with left tail probabilities, and we've got right tails with right tail outcomes with right tail probabilities. And what we're trying to do is try to understand those probabilities along with the pricing of those probabilities and guess whether or not we think those probabilities are accurate from our point of view or opinion. That's all we're doing. We're handicapping the world as we see it, which is sort of fun. I don't know. If you're a degenerate junkie like me, it's fun, I should say. Here's my point, that at 19, you have, on one hand, an elevated VIX relative to where we've gone, elevated option pricing relative to where we've been just a couple of weeks ago. Mid and early December, as we take a look here, we were in the 13 handle. I think we were even tagged the 12 handle at one point. We were in the 13 handle. And to me, I could not wrap my mind around how that makes sense. On one hand, the market there's a lot of risk in the market, but that same risk we've been managing and we've known about for a very long period of time. And it seems like the market had sort of taken that risk and said, okay, we've processed this risk. We're going to discount gold by this amount, or silver by this amount, or bonds by this amount, equities by this amount. And at some point, maybe there's no real need to see option implied volatility high if you've sort of distributed that risk out to individual instruments, I suppose. But still, 13, given the risks that we're looking at in the world, with the new administration taking over, with the new possible trade volatility and the sort of the unknown positions of the new administration, to me, I thought, yeah, I get the tax cuts, but what about everything else? And it seems like over the last month, the market has priced in higher volatility. There's been a reach for protection. So on one hand, you could say, all right, the market is not as exposed as it was 1 month ago when volatility was as low as 13. The market's not as exposed. Participants have bought protection to some extent. Now, here's the problem, is that we've had if you remember, you've been rocking with me for a while. I've had a few years ago, I had a conversation with Jem Carson. We talked about, quote unquote, the danger zone. I talked about the area slightly above the historical average for the volatility index. So the long-term historical average is something like 17 or 18. My question is, what do you do with like 18 to 22? What do you do with slightly elevated volatility? Look, if you give me a 40 VIX, I know what to do. You slam on that thing and you hope for the best. And you keep your position size respectable. But, you give me a 40, 50, 60 VIX, something crazy like that, I know what to do. I think most of you know what to do in that situation. There could be some pain. But I think we all understand volatility and mean reversion and the odds that we'd be getting in that type of scenario. But what do you do with just slightly above historical average in the 18 to 22? And his answer was fascinating to me, and I continue to talk about it every time we get in this range. His point was, when you start to get in 18 to 22, the market is telling you that there are risks there. Not only has there been a reach for protection, but there's a reason for the reach for protection. And what he said is, when you get into 18 to 22, you have to be careful about selling. Now, he didn't say not sell, but you have to be careful about selling because your highest probability of the vol spikes come from that range. So like if you're at a 13 VIX, maybe it's much less likely you're going to get the spike in vol to the 25 to 30, something like this, to the upper 20s. But once you get to 18 to 22, it's much more likely you're going to get that sort of expression of volatility. And so I've never forgot that from that conversation. We went through the data that supported his point of view on that, and it made a lot of sense to me, just anecdotally from my own trading experience. You tell me what you guys think. Feel free to start typing in the chat. But so every time we get in this 18 to 22 zone, I'm a bit careful not to just say, oh, we're finally above long-term historical averages. Let me go slam, get short Vega. I'm a bit more targeted than that. So that's the two minds. The two minds are, just a month ago we're at a 13 VIX and now we're at 19. So relative to our short-term pathway, we're slightly elevated. But if you were to look in the past, what happens when you get into 19? Do you see a lot of turning and stopping on a dime, or do you see more instances of getting to 19 and spiking up towards the mid-20s or even higher? I think you see just in the last year or so the instances of us going much higher. So I think it's something to note. Now, the flip side is this morning, vol got super extended at 22.5. And so that might have been the opportunity for the market to slam us back down to 19, right? And so we did see massive vol selling here today after, some freak out. So who knows, maybe today was that sort of max pain moment for the market, maybe in the short term. And I sort of would be looking, it's weird to say this. I personally am looking for things to add in this market. And that's the way I roll. That's the way I rock, right? Like when everybody's super excited, which they were a month ago, and there were no risk on the horizon and everything was great. You got to buy upside calls. You got to get long. That just doesn't make sense to me. And there were fewer and fewer people saying the opposite. So I wasn't as bold up, but I was looking for opportunities. Those opportunities were energy. Here's my themes. My themes were energy, for the simple fact that a lot of those stocks had been beaten up. They had gotten cheap from a price perspective. I'm going to put away valuation for a second. From a price perspective, they had gotten beaten up, especially the higher beta names. So in each one of these classes, so we've got sectors, industries, and then within those classes, you sort of have what are called style factors. So a style factor would be high vol or high beta stocks, low beta stocks, high dividend paying stocks, growth stocks, small caps, mid caps, all those things are sort of style factor preferences. And you have all of those things can be within a sector or in an industry. So what I like to look for, depending on the scenario that we're in, cheap, what I think are cheap sectors, and then with a decent beta on them. Not super high, but with a decent beta. So in energy stocks, why was I looking at energy? Well, it's because energy is only 3% of the S&P 500. To me, that makes absolutely no sense in a world that is hyper concerned about energy for right or wrong reasons. And in a world where if the AI hype train is true, if digital currency hype train is true, if electric vehicle hype train is true, and I can go on and on about these new emerging industries that are going to be completely energy, much more energy dependent, then I just think 3% of the S&P doesn't make sense. It just doesn't make sense to me. I'm probably getting value over a long enough period of time. That's what I think. And if the market, if investors don't want to buy up energy or utilities, meaning nuclear companies, then my sort of backup plan is I don't want to say pretty sure. My bet is that the technology companies will buy them up themselves. As strange as that may sound, but vertical integration, especially for nuclear, is probably likely. And we saw some of those things, not vertical integration, but partnerships between big technology companies and big energy companies, CEG being one, which took a bit of a hit today after a absolute rip on Friday. But anyways, main theme number one was energy at the back end of the year. And it's done really, really well the last couple of weeks. I don't think we bottom ticked this by any stretch of the imagination. I think we're maybe a week, maybe 4 or 5 days late, but it's done pretty well. And energy, crude oil's ripping higher, which at mid 60s, something like this, given the geopolitical setup of the world, not surprising. Didn't call it, just not surprising. But I just think you got cheap energy at the same time you had cheap WTI. Which way could they both go? Could WTI be $30 next year? I don't know. Maybe. Things are pretty bad if that happens. Could it be 80? Yes. And that puts a real dent in what's going on with inflation. More on that later. So the other point was XLE was one. The other was XLV. And I'm not saying XLE specifically, but XLE and constituents, and looking for things with decent beta, not too high, but decent beta. And then XLV, which was the healthcare stocks. So the idea was that a lot of these healthcare stocks have been beaten up around the election time. Why is that? It's an anticipation that once Trump gets in, he's going to put RFK Jr. in a position of power that would potentially have negative impacts for future revenue for a lot of these healthcare companies. And that gets discounted in advance. So that happened in advance of the election, and then it happened in advance of the Secretary of HHS appointment and confirmation. And then, a couple of the things happening in healthcare insurance companies aren't necessarily helping either. The point was a lot of these things got super cheap. Pfizer got super cheap. I would say cheap on a price point of view relative to recent history. Okay. If we go out far enough, these things are not, super cheap. And I'm not talking valuation. I'm just talking short-term price here. Let's go. So Pfizer, Eli Lilly, and then Moderna as well. And the point was, if the market wants to rip higher, we want to find higher prices, that there's a potential that just market beta alone will carry healthcare higher. And if we want to find lower prices, well, those big money managers who can't put their clients' money in cash and just sit there, they've got to find instruments to buy. And in those types of correlations to one, stocks go down market, they look for low beta assets and they look for defensive sectors. Healthcare happens to be a defensive sector. And so you tend to get people that go try to find these types of names in periods of weakness. So we're probably getting some decent value here. But what's cheap can get cheaper, and Moderna is one of those scenarios. Today went from $40-something all the way down to $35.15 was the closing print, but an extended is trading even lower at $34.90, down nearly 17% today on really, really bad forward guidance. I bring this up effectively just to say, because I know everyone has different trading styles, but I don't look for the high flyers and try to ride the momentum to the upside. I try to buy some of the dogs and wait. Have some of these companies committed crimes against humanity? I don't know. You be the judge. You be the judge and jury on that one. All I'm looking for is cheap assets that may provide value in the short term for a little bit of a gain. Let me pause for a second, just see what you guys are talking about here in the chat. LFG. I know nothing. Thanks, Mr. Market. I couldn't agree with you more. Sleepy. It's the end of the world as we know it. And I feel fine. All right. Thanks for going on this again. No problem, Victoria. This is the January effect for Euro USD. Interesting point. Interesting open this evening. Yeah, they're taking them up a little bit here. And Vol's not doing much though. So I don't know how much a stock I'd put into this because Vol, /VX isn't really doing much. So equities are rallying here on the new open. Am I long only, says Anatable. No, I'm not. I'm definitely not. So what I've basically been doing as I've been long, when I say long, just it means overweight. So I've been overweight materials. I'm overweight energy. I'm overweight utilities, but specifically in nuclear. And those are the nuclear thing is a very long-term position for me. I'm overweight China. And that's from a while ago, before that kind of crazy 50% pop in a lot of those assets. Yeah, so those are areas I'm long. And then where am I short? I run tactical shorts using futures over the top of the portfolio. So I'll go like short NASDAQ against my long basket of stocks. And that long basket will be overweight materials, energy, all the things that will sort of be likely inflation catalysts. And then I'll be short tech because higher inflation will mean higher interest rates, which will likely mean you need to take down your future projected income for a lot of these growth monsters. And I think those things suffer the most. And then for whatever reason, even though if you listen to anybody, if you listen to this show, I thought we'd see higher interest rates in the long end on the cut. We got it. And I thought we'd see a 5% 10-year sooner than later. It looks like we're headed there. I just can't. There's some part of me that just cannot resist. You get 9 heads in a row. What's the gambler's fallacy? You bet. When I say 9 heads in a row, you bet tails. Just because that's what I'm looking at here. I'm looking at bonds going, I got 9 heads in a row, meaning every day goes down. It doesn't take much. It's like, I don't want to use that as a reference, but I was gonna say if you've got a dried forest and you get some sort of spark, things can go up for obvious reasons. I don't want to use that reference right now, but I'm just, you get where I'm coming from. The point is, it doesn't take much because if everybody sees bonds going down, we're all thinking the same thing. This is going to rally sometime, but where, from where, and from when? From where and when? And I think that's probably the mood of a lot of people right now. Where is the value to be had? We might be close. Is it here in the 10-year? Is it somewhere at 4.77%? Is it at 5? Is it going to be at 5.25? I think many market participants, in particular traders, are probably going to be looking at where that is. And what that means is, as soon as you see some side of strength, you're likely going to see some sort of snapback rally, even if it's not sustained. I've been referring to that. I don't know what the technical term. I'm sure there's a technical term. I've just been referring to it as a trader's rally. We sort of got one here, right? We got our 3-4 point rally from 116 to 120. And, you know, I thought we'd get more two-way action on our way to 5%. We just haven't. So I'm getting caught in trying to trade the counter trend. Sometimes you just trade the trend. What is the trend? I think bonds and interest rates I think bonds are going to keep falling, and we're going to work our way towards 5%. I think that's where we ultimately end up. Maybe not bonds, but notes. I think notes get to 5%, which means I think bonds are going to be at 5 or above. But I also thought, for no real reason really, but I also thought, like, as you get closer to 5%, the trigger finger gets close. You know, people want to pull the trigger, and we get more two-way action. We just haven't seen it, man. Bonds continue to move in a single direction. We hit 110 in 25-30 seconds earlier today. 110 handle. That's wild. Look at the chat. VW says buying TLT with both hands the moment the 30-year hits 5%. Exactly, man. Favorite nuclear stocks. I really dig your thesis. I'll go into that in just a second. Anatable says I bought TLT today. Rezo says we're not that far away. I know, but I think I broke this down. This was probably in November, headed into the December FOMC. And what I said is, at 4.6%, okay, they put an FOMC in front of everybody, and they said 2% growth, 2.5% inflation. They said 2.6% inflation, which would put you just back of the napkin. That puts you at 4.6% yield. And at the time, we were like 4.55. We were right there. So if you believe growth is true, and if you believe inflation is true, what could happen? So growth could be understated. So let's put growth at 2.5%, and let's put inflation at 2.5%. You're at 5%. Let's say growth is overestimated. That puts growth, let's say 1.5%, inflation 2.5%. That puts your yields at 4%. But in that world, would inflation be 2.5%? Probably not. But if it was, we're probably looking at a stagflationary world. So in that case, likely inflation is overstated as well. So you're at 1.5% plus 2 is 3.5%. So when I think about the risk and reward at 4.6%, I think, okay, maybe my risk in getting long bond position here is 40 basis points to the upside. And worst case scenario, if growth gets to or stays at 3% and inflation is 2.5%, you're looking at 5.5% yields. Possible. Maybe. But I don't know. That's a wild world. How does a combative president with sort of aggressive trade policy, how does that lead to a world of 3% domestic growth? Doesn't the world have to be getting along, and don't we have to be engaging in free trade to see ourselves hit in a new administration with tariffs and sort of bilateral and new multilateral trade agreements? I don't know. I just don't see that outcome. So it's possible we get to 5.5% yields. To me, somewhere around 5% plus or minus 25 basis points probably seems right to me. Now, the risk is we get there and we don't go anywhere. To me, that's the bigger risk. Do I think we go to 5.5% 10-year in 2025? No. Do I think we could go to 5.25, and just sit there, which means a long bond position doesn't really pay? Yeah, I think that's a bigger risk probably. So anyways, the trend move is to continue to move lower and head towards 5%, in my personal opinion. The counter trend move is playing the bounce. And you just have to decide what to do with that, in my personal opinion. I like the traders bounce to the upside here. And if we can get it now at 4.75, and let's say yields drop to 4.6, 4.5, then I would love the opportunity to reload a short. Because I don't love shorting the whole. Can you imagine getting short here after we've already dropped from 127 to 110, and now you want to establish a short? To me, the risk and reward of that, it doesn't make a ton of sense. It might pay, but it doesn't mean it's the most interesting bet on the board. So anyways, that's sort of, my mind is in many different places, if you can imagine. I'm long materials, I'm long miners, I'm long energy. All those things are sort of inflation, will benefit with the idea of additional inflation or additional increases in raw materials. I'm short. I'll run tactical shorts over the portfolio on the NASDAQ, and then I'm tactically long bonds. And that long bond is not paid off at all, really. But you win some, you lose some. That's the way it goes. Hope that answered the question. Let's see here. Evening Vic. How are you positioning for the upside in bonds outside of buying TLT outright? What's the option play strategy you'll use to express the reversal in bonds? It's just out of the money upside call spreads. So bond vol is typically pretty low. Not always the case right now, but bond volatility is typically pretty low, and it's pretty simple. I'll go 30 to 45 days out, and I'll buy upside, like 30 deltas, 40 to 30 delta calls, and sell something against it, just to keep the risk minimal, to keep the capital outlay minimal, depending on the price. Sometimes we'll just buy the upside if it's super cheap. So yeah, nothing super fancy. Nothing really fancy. And so some of the bets over the last two cycles haven't paid. So that's the point. Like, those things don't pay, but I keep those bets relatively small so that if they do pay, because they're futures options and because they're leveraged, I'm gonna see a nice return on some of those things. But if they lose, it was risk defined, and I can, it's not going to do anything to the portfolio. Can't we sell covered calls on TLT? I think so. That's probably an interesting way to go about it. I just have always had some issue with the commodities related or commodities linked. I know it's a commodity, but I'll bring it back. A commodity linked ETFs, starting with like USO, starting with USO and then GLD, and TLT is kind of in there as well, which is there's some drag built into these ETFs, and I don't love that. With TLT, I think it's less of an issue, if I'm not mistaken. It's been a while since I looked at it. I think it was less of an issue, and I think selling covered calls is interesting. But here's the problem. I think once you get that move, it's probably going to happen quick. That rush to collateral, if that's what the spark. I don't think so. The way that we're selling off slowly, if a bond rally comes, I don't think it comes as slowly as we just got the sell off. I think it's the opposite of the VIX in a way. The VIX spikes higher, drifts lower. I think this drifts lower, spikes higher, because likely your most likely scenario is a run for collateral. Some growth scare, some event that spooks the marketplace a little bit. That's what we got back. What was that? August 5th or something like that, with a reverse yen carry trade. Something like this. You don't know what that spark is, but it could be out there. And the problem with the TLT of, short call on TLT is if you get the spike, you get the run in bonds. Now you're short the call, and you got to figure out what to do with that short call that's losing money against your long TLT. So that's the drawdown. But that's what we do here, right? Like, you're just trying to think about all the potential scenarios that could play themselves out and put yourself in a position that could do well. But there's no perfect scenario. It's just matching up what you think could happen with what actually does happen and trying to be as close to that as possible. All right, let's keep cruising here. Great questions. See, yeah, Rezo says it as well. Of course not. There will be a dog pile on bonds to get long when it breaks. Exactly. That's exactly right. So you can go long TLT and sell calls against it. And that helps to pay that drag. That helps to minimize the costs where you're in it. But it's just when it runs, then what? Now you're trying to manage a short call that went in the money, and you were right, but you got super limited on your upside. Like that's a potential outcome. All right, let's get off the subject of. Let me do this real quick. Let's talk about the calendar this week, and then I'll get off bonds, because the calendar this week is going to be, it has some decent catalysts here for fixed income. PPI, of course, on Tuesday, and then, my friends, we are going to get on Wednesday. We always get the mortgage applications. I've been watching those, as I know. You guys know we were waiting for a while for this break in home construction. We finally got it. ITB, just disgusting chart. XHB, disgusting chart. Yeah, I don't know. Some parts of me, it's sort of, I don't know how people don't look at this and get spooked out a little bit, but I don't want to be Chicken Little here. CPI on Wednesday, my babies, 0.3% month over month is the consensus expectation. 2.9% year over year, which would be an acceleration year over year from the previous report. 3.3% would be constant. Last month was a reacceleration of 0.3, and then core. Expected to decelerate a bit month over month from 0.3% to 0.2%. Going to need it. If that accelerates, who knows? Who knows? Gosh, I wish we could get bonds to turn around. 3.3% year over year core expectation as well. The consensus range is super tight. Basically, there's no range. Is this right? 2.9%, 2.9%. They super confident. Let's go to Cleveland Fed. Cleveland Fed. All right. Their inflation nowcast, to me, yeah. Forward inflation expectations, 2.3%. Yeah, this stuff really isn't moving, but it's all staying above 2%. Forward expectations all between 2 and 2.5%. It's not going below. So if you're expecting inflation to get back down to Fed target anytime soon, you might want to grab a Snickers, my friend. We might be here for a while. The tough thing about rate of change is people get used to it. That's a sad thing, That's a sad thing a little bit, that like 2.5% feels good when you're comparing it to 9%, but it's still not good as a society. It's still leaving people behind at a much faster pace, I guess the weird way that I think about it sometimes is you have to increase your productivity or your efficiency or your skills in order to earn at least 2.5% more from the marketplace at an annual clip. And I think, or in cases where we had sick inflation, 9% annually, which really wasn't 9%. It was probably something like 20%. You had to increase your skills. If you were a labor participant, you had to increase your skills, your productivity, or your efficiency by 20% on an annual basis just to stay even. If you were an asset owner, that's not necessarily the case. Your assets could have done the work for you. But I think we understand that there's like 60% of the people out there where that isn't necessarily the case. So you're in an environment where you have to increase your wage return from the market 20% just to stay where you're at. And selling out to like 2.5%, 3% is still difficult for a lot of people. You still have to do it. We still have to find a way. But to me, it just means we leave people behind at a faster rate. Those people that are unable to increase efficiency, increase productivity, or increase the skill set by 3% annually, or they just run into a hardship. We leave those people behind at a higher clip. But we forget, because 2.5% doesn't sound like 9%. So all those crazy hair on fire inflation stories don't run anymore. But it's not like it isn't a problem. All right. Sorry for the aside. I can go into dark spaces sometimes, people. Anyways, Thursday is retail sales with the housing market index and a few other items. And then Friday, housing starts and permits. So it's some decent housing numbers. Baker Hughes rig count on Friday, which will probably start to become a thing that people are going to watch. A couple of Fed squawkers, but not many. Neil Kashkari, Austin Goolsbee speaking on Wednesday. But a decent catalyst for economic data. PPI, CPI, retail sales in 1 week. It's a pretty decent week, plus some mortgage numbers. And then on the earnings front, Wednesday, we've got JP Morgan, Wells Fargo, Goldman Sachs, BlackRock, Citigroup, and the BNY, Bank of New York Mellon. All kicking off earnings season on Wednesday. Thursday, United Health Group. That'll be an interesting call to tune into. Morgan Stanley and a handful of others here. U.S. Bank, PNC. And then Friday, Schlumberger. So there's two interesting oil and gas names. Kinder Morgan, KMI, and then Schlumberger later in the week. But then Texas Instruments, Charles Schwab, Regions Financial, Huntington Bank. So there's some a lot of the banks will be reporting this week. I think Texas Instruments and Schlumberger are going to be interesting outside of finance to probably pay attention to as well. TLT has yield. You get paid to wait. That's true. Raises are currently 2 to 4% a year, says Rezo. So here's I always say this. You're not wrong. You're totally not wrong, Rezo. And all I wish to do is sort of put something out there into the world, because I hear this done all the time. And I used to say things like this too. And then I sat down one day or 1 week or a month or something, when you just go through the econometrics, you go through the details of the numbers, you stop talking about the numbers and go, do I actually understand this number? Do I actually understand the construction of this number? So like with inflation at the very beginning of this whole cycle, before inflation was ripping, maybe we're at 3-4%, something like this. I think maybe it was before that. It was like, do I understand the construction of this number? And the truth was I didn't. And once I went into the number, I would listen to people talk about the number, and I realized they didn't. They were talking about it as a concept, but they didn't know when that number got spit out, how did you get it? And so wage is real, right? It's an average, sort of this median number, but it is real. If you have a wage of X and it goes to 1.02X, that's real. That's observed data. Inflation's a model. It's not real, and it's also different for everyone. So my issue with when we compare wages to inflation and we say wages are running 2 to 4% increase per year, and that is more than the inflation number, which is 2.5%. I go, yeah, but the inflation number is bullshit. It's a model. It's our best guess at modeling a very complicated reality into a single number that then we can use for the purposes of financial modeling and financial assets. But it's bullshit. Like, do you think when we had that 9.1% inflation print, do you think that's what inflation was? Do you think it was 9.1%? Or do you think it was closer to 20% for most people? The truth is, it was probably closer to 20%. It was probably closer to 15 to 20% for most people. So my thing is, there are reasons the inflation number, CPI, is constructed the way that it was constructed, and it's been changed over time. And there are reasons. There's incentive structures that why our society and our marketplaces and our government chooses to take those changes in certain directions. And I don't think it's trying to find a more accurate or true reflection of inflation. I don't think that's the incentive structure. Call me crazy, call me a tinfoil hat type of guy, or call me a cynic. All of those things could be true. But I think my only issue, Rezo, with that argument is that one of those things is real observed data, not a survey, real. And then one of those things is some of it's real, some of it's a survey, and then it's all put together in this weird sort of concoction to model out a number that was specifically designed after the Boston Commission to minimize or lower inflation, which then would minimize the government's payouts while increasing tax receipts, and found $1 trillion in the budget when there was a Congress that sort of refused to negotiate or find room in the budget or cut. So this is the way that they did it. And we never changed it back, even though we know that that was the case. So I don't know. I see the world. Inflation's a fake number to me. So then when people compare one to the other, I'm like, you're comparing apples to oranges. And it's hard for me to think about those two things as a real talking point that I'll take, honestly. And maybe I'm wrong. So if I'm wrong, you guys explain it to me. Hit me up at Victor Jones, the Owen Jones is 0 on Twitter. I'm super active there, but you can explain to me why I'm wrong. And I'm looking to be proven wrong, by the way. Because if I am wrong, it's gonna disinform or misinform a lot of my other opinions. When I look around, raises seem to lag inflation. So we are trying. Yeah, I agree with that 100%. Raises do seem to lag inflation. And they would lag inflation less if the labor supply didn't have 15 million more people in it. You know what I mean? And that's not an anti-immigration statement. It's just a supply and demand curve. So it's just, isn't it interesting at the same time that we increased our money supply by 40%? And we had these massive government spending programs, these massive monetary stimulus programs. Isn't it also interesting we just happened to forget about the border for a few years? That's not a Democrat or Republican thing, people. If you don't do that, wages, you're gonna have a problem. And not only did we, even with all that happening, how many strikes did you get? You know, the Postal Service strike, the dock worker strike, the writer's strike. Even with increasing your labor supply, you still got tons of strike, and you only have 6% of the workforce in labor unions, and all you heard about was striking workers. Imagine if the labor force was like it was in the 80s, when you had 20% of the workforce in unions. I don't know where I went. Sorry. I gave you some of my deepest, darkest thoughts for a second. That this is all conspiracy. That it's not Joe Biden who opened up the border. It's like it's a cause and effect thing. Like, okay, we did this. If we don't do this, then this is going to happen. And because I have money and power and I own a corporation and I don't want my margins to do X, which will then cause a stock market crash. And because we have so much put into people's 401ks and the boomers are getting ready to retire, you can't have that. So what do we got to do? Well, you got to save the margins. We got to increase the labor supply pool by a lot. I don't know. Maybe I'm crazy. Welcome to the 70s. You want to know what's crazy, Rezo? Okay, I'm going to hit you with one more like quasi-conspiracy theory, and then I'm going to get on to real stuff. I went into I bought my wife some jewelry for Christmas, and I was going into like these jewelry stores, those nice jewelry stores. I don't want to be in the doghouse. So I was going to those nice jewelry stores, and I was asking about the designs. Can't believe I'm that guy, But I'm asking about the designs, and they were telling. What I realized is every one of these jewelers, these storied, legendary, jewelers have been around for a long time. They reintroduced their designs from the 70s. These bracelets and watches, they were bringing all their designs back from the 70s and 80s. And I was like, oh, that's interesting. But I'm weird. I see stuff that's probably not there. Like, that's strange. If I start seeing people wearing bell bottoms, bro, I'm like, we live in a simulation. If one of you throws on a pair of platform shoes with some goldfishes in it and some white bell bottom pants and a polyester suit, bro, that we live in a simulation. And I'm guessing one of you sitting there right now at your computer going, how did he know? Oh my gosh. All right. I'm going to keep going. Sorry. Somebody's asking about nuclear. All right. Let's talk about sectors for the day. So sectors for the day. Utilities got hit. Technology, obviously weak on the day. Materials and energy. What do you know? Materials, energy, and healthcare. Bing, bing, bing. Winner, winner, chicken dinner. The big winners of the day. Materials up 2.24%, energy up 2.2%, healthcare up 1.3%. And that's with Moderna getting murdered today. Real estate also up 1.23%, which I think is interesting. Grumpy Mike says, is my webcam on? You know why? This is like a stream of dad jokes for people who appreciate dad jokes, and maybe like a little like a lime. If conspiracy theories were a lime, we just kind of squeeze the lime into the stream. That's what this is. Dad jokes with a squeeze of conspiracy theory lime juice, or lemons, not limes. So here's kind of what I like. As CCJ gets cheaper, I'm not sure if it's cheap enough, but on 50% retracement for $36 up to $62. Let's see here. We're getting close. 36 to 62, excuse me. We're now back down to 48. Down near 0.9%. So somebody asked earlier in the stream, what are the instruments to play the nuclear theme? This was my biggest one. CCJ. The second and smaller one is SMR. This is a really, really high beta name. So this thing swings like crazy. I make this joke all the time. It might not even be a real company. It is, but it's super high beta. So this one it's a smaller position, but the returns on it are magnified. Returns are both positive and negative, by the way. All those two things, or that theme, and you could probably go. What's the other one? I'm forgetting. I'm forgetting them. But the uranium miners ETF is another one. Can't think about the other one offhand. And then Albemarle, which is also another one of my babies, had a really, really good day today, up 5%. So this is lithium, though. They're one of the biggest lithium producers. So this one had a nice day. So my point is, within the nuclear space, those things are starting to get cheap. I haven't picked up any just yet, but I do think that those are the ones on my shopping list. So as those get cheaper, those are the ones that I want to start picking up as they get cheaper. And then outside of nuclear, we talked about. No, I think that was the one. You guys wanted me to speak about what I was in the nuclear space. But then there's also this little guy. So then outside of this little guy, or outside of the nuclear theme, the only real AI play that I've had real material money behind has been Palantir. And I'd made this joke on the first call on each Sunday of the last couple of weeks that I was on talking to Pete and Tom. And Tom, to his credit, had said at any time this thing will peel off 20%. This thing is massively overvalued. I don't know if he said overvalued. It's too expensive, right? That means price. So too expensive, and he wouldn't be surprised if this thing's going to cut off 20%. Same thing with Pete. They didn't want to be long. And I suppose I'm long from like $13 or something like this. So to me, it's very different, right? I wouldn't get net long either as a first long at 85, but long at 13 feels a little bit different. And so my point of view is, well, if it does peel off 20 to 25%, to me, I'd probably love to pick up more. I know the forward valuations on this thing is super stupid. It's not a great value as it once was at like $5-6, something like this, especially at 13. And I don't say a lot of people, I see many people that I respect in the space talk about filling this gap. So that gap between 40 and 45, I think there are a lot of eyes on whether or not we can get down there and fill that gap. So I guess the way that I think is that would be $45, give or take. $40 if you're being conservative. So let's go $40 for the conservative people out there. 40 to 65, that's $25, right? So take half of it. At half of it, maybe 50, 52. That's the area where I probably, if we get down there, I buy a little stock and I probably sell some out of the money puts. Here I probably wouldn't be buyer stock. Maybe I'm buying upside call spreads to have super limited upside in case it never gets down to my price targets. At 50, I buy stock and I probably sell some out of the money puts. And not too big either. And then, it doesn't have to be this binary thing of how do we catch the bottom, or do you think it's time, or, I don't know. But I think it's just how do we create a plan around legging into instruments you like or getting exposure to instruments you like. So the problem is vols here is a bit expensive to do, to buy upside call spreads. But that will pay off in our favor when we are selling puts if we do get down to 50. Vol, 60, mid-60s to mid-70s around their earnings coming up February 3rd. Oh, this has got to be a play. We've definitely got to do something on this one. See, my favorite thing is when a stock discounts into earnings. I've done this before and it's hurt me. But for whatever reason, psychologically, I really like when a stock is discounted into its earning event, because that means to me at some level it's been de-risked. And to me, it changes the probabilities. I don't want to say that. I don't think it changes the probabilities. To me, it changes the way I think about the probabilities. That's a better way of saying that. So let's see. What can we do here? Yeah. A buck out for those 46s. Doesn't look that bad to me. Right? If you like it, I don't know. A buck for those 46s doesn't seem that bad. $1.70 for the 50s. Maybe both of them together. I kind of like this one. I might be shooting this one off tomorrow. Because I wouldn't, if it fills the gap, okay. I'll take it. I'll take a little pound here at 50 or at 46. How about you? And if not, we just take a little premium in on it. These scaredy cats, it was down 3% here today, and all these scaredy cats are scared of that gap fill. They want to pay us $1 if it happens, and we get to establish a position right at the gap fill when everyone else is puking and panicking. I'll probably take that. Any takers? I'm in. Let's see what they're saying. Vince. Oh, Vic, why not sell 45 strike puts now? Then if it hits, sell more. I agree. That's a great idea. By the way, Max, I saw your comment and then went and looked at the 45. So all credit, if anyone likes that idea, it's coming from you. Because when I saw the sell the 45 strike puts, I went straight to the option chain to go price them. I like the idea, my friend. And you know what's funny? Working on the opposite side of the brokerage business is I know when you look at the option chain what you're going to pick. You're going to go for the 46s. Why? Because everybody goes for the dollar option. I don't know why it is. I don't know what it is about that psychologically, but everybody picks the dollar. It's like anything less, maybe you assume is anything less than $100 seems like you're not making enough. Anything more, you're increasing your delta and your risk. And so people pick the dollar. I think it's fascinating. All right, let's keep going. Bitcoin at 94.3. Not surprising this one rolled, but I thought we would get much higher. You know, to peak out at 108 and then roll over. I didn't think that. I thought we would get to 115, and I'd said that many times on the stream. So we're getting weaker much sooner than I thought. Yields, but I guess here's the counter to that. Yields are going higher much quicker than I thought as well. So I guess I should keep that in mind. I didn't think we'd go straight to 5%. I thought we'd have two-way action, and in that world, Bitcoin, maybe it had a chance to get to 115. Yields are going straight to the moon right now. And you got to factor that into the long beta non-yielding assets like Bitcoin. I don't love a trading entry into Bitcoin here. But as a trading entry, I would probably like some of the proxies. I don't know. I still don't know if I can pull. I still don't know if I can pull the trigger on Coinbase. Going into earnings, a good quarter. What's their forward guidance? Probably good. A new administration. All that's been priced. What are they giving us? Whoa. They're giving us some money to sell these 180s. That doesn't look half bad. See, a lot of these things have pretty decent implied volatility here. Giving us a couple bucks to sell the 180 puts. I don't hate that. What say you, chat? Yeah, man, I was that chicken puking today. Reload. Vince K. I'm with you, man. Yeah, I think it's the hardest thing is just sizing the positions, sizing the positions and then doing some stress testing on your largest position. That's what not that I'm some great trader or whatever. I'm just sharing some war stories so that if there are newer people out there and if this can help, then use it. If not, or if there's a more wily veteran out there that can give better advice, feel free. But what I do is on my positions page, I sort by my capital requirement. So basically my largest positions I want at the top. And then I just stress test 5, 10% higher or lower. How do you feel? And then based on, in a smarter way would probably be to say 1 standard deviation, 2 standard deviation move. How do you feel? But whatever. I'm just giving you something easy to think about. 10% up or down on that capital requirement. How do you feel? Do you want to go lay under your desk in a fetal position, or are you going outside? It doesn't matter. And if you're closer to the former, well, then how could you use options to turn that risk, the risk of that position, into something where you could go outside? And so sometimes for me, that's why I talk about turning my long stock positions into collars, because it's all around turning my largest positions into things where I could go outside. And if sometimes I don't like the pricing of the collar, I don't like the strike availability, or I just don't want to turn it into basically a synthetic vertical, then I just decrease the position size. But hopefully you have a process where you can sort of stress test yourselves before you get into the situation, because that's a lot harder to make a game theory optimal decision, right? Like it's harder to make the optimal choice when you're already in the stressful position, when you're already feeling the feeling of fear, and then and trying, it's just, you can do it. Lots of traders have been put in that situation before and are still able to maybe add to a position or whatever. I should say it like this: manage risk appropriately in those scenarios. But it's harder when you're in the scenario than it is to plan it out, game it out ahead of time. All right, real quick, let's talk about crude oil. Crude oil at 77.20. I told you I'm the world's worst crude oil trader. I do not have a position on a crude oil. I'm just long energy names. Same with natural gas. I wish I was a better natty gas trader. And I guess the only way to get good is to start somewhere. But this thing whips around so crazy. Every Sunday night, this thing is up, 4, 5, 6, 7%. I think it was up 7% yesterday. Got murdered today. So yeah, the whole energy complex is moving higher. There's a lot of geopolitical reasons behind that. Sort of gamesmanship happening between the current administration and the future administration. But I suppose without going into the narrative, the whole point here is, to me, a lot of these energy stocks, or XLE, that they have been working. If I was a betting person in the super short term, I don't know that I'd take a new long here on XLE at 90. I still think it's cheap. I just think from like a tactical entry point, maybe I'd give it a few bucks, give it a breather, let oil sit somewhere. I probably wouldn't put a new long in here, but I still think XLE, I would still be I'm still adding to positions here in energy. Where was I? Oh, gold and silver. Gold on a nasty little move today. Nasty little 50-point move to the downside today. Silver was ugly too. $1.26. Both of these things were pretty ugly. It seems like this silver trade, man, they're making it hard to be long. Super hard to be long in silver. If they bring gold, again, I'm going to give you my price targets. 2,600, we've seen some buying here, and we've seen the reports of the CCP effectively increasing their gold purchases anytime gold gets down to 2,600, and it's put a bit of a floor in that market. I'll be interested to see if we can break that. I would love to get new longs in at 25. And for that reason, I haven't been going long crude oil itself, but I have been going long crude oil. I haven't been going long gold, but I have been going long gold miners like Newmont Mining. Same thing with copper. I think the narrative on copper and China is bad right now, very bad. So I like going long a little bit of FCX. But here's the thing. If in order to go long new positions here, you sort of have to believe this is a correction. And I think we have to open up our mind to the possibility that the market pulled forward a lot of forward returns over the last couple of years. How many 20% years did we just have? We just had 2 20% years in a row. And since the pandemic, the returns on equities has been insane. And at some point, you have to ask the question, all right, unless we're going to go back to this same playbook, which is to spray down global markets with liquidity, have we not already pulled forward a lot of those returns, those future returns, into the present value of equity prices? And if that's true, the world where you get something that looks more like the average, right? What's the long-term average on equities? 8, 9%? It used to be 7 when I was in school, but because we've just gone to the banana world, it's now closer to 10%. But in a world where we expect something closer to normal, what is a 2%, 4%, 6%? What does that year feel like relative to 2 20% yields? It's going to feel like a down market. And my point is, even if I'm choosing value, in a world of low or muted returns or even negative returns, all of this stuff could get cheaper. So choosing value is no like special secret in order to make money. Yes, am I buying low? Sure. But if beta, which is like all market returns, if market returns go down or are muted, well, that doesn't necessarily guarantee me any upside, because an equities return is beta plus alpha, right? Beta is market return. Alpha is the stock's return either above or below the beta of the market. And that's the return of an equity. So I would like to theoretically see decent beta in order even to make a value play. All right. I think we're last 12 years maybe. Yeah, Grumpy Mike. Sleepy says this is not normal. Yes, there have been times when it goes down, but when it goes up, it rips. Oh, you're talking about GC. Me like GC was good for the straddle that I have on a GC. Yeah, I don't want to short gold. I haven't, there were some times earlier where I sort of liked the gold short. I don't like it right now. I think if it breaks 2,600, it could get a little ugly to the downside, but in those cases, I'd rather be a buyer than a seller. I think the world has to settle down for some geopolitical risk premium. And I also think people have to start having more confidence in government spending. They have to want to go back to buying bonds as a safety asset and not necessarily hard money assets. Are we close to that? I don't know. Are we closer to a world of using soft power and not necessarily heavy-handed economic sanctions, weaponizing the dollar? I don't know. And if we're not closer to that world of fiscal responsibility, soft power, open trade, trust in government and government responsibility from a fiscal standpoint, and monetary policy and central bankers, if we're not closer to that world, give me the catalyst for why investors want less gold and not more. I don't see that. For that reason, I'm going to be really careful about shorting gold. I would rather buy the miners when they get cheap and buy gold when they get super cheap. That's my story, and I'm sticking to it, everybody. From Bali, Indonesia, I want to thank you for sticking around and listening to the ramblings of a quasi-conspiracy theorist madman trying to get healed out here with the fam. I'm just kidding. We needed a vacation, so we took one. If you want to hit me up on Twitter, you're more than welcome to, though I'm less active out here because I deleted a lot of the social media apps off my phone. Be a little bit more present with the fam for the next couple of days. But at Victor Jones, the Owen Jones is a 0 because I like to be difficult. Good luck out there, everybody. Again, my key themes for the year: nuclear. Even though I don't know that it's a great setup this year for nuclear, I think I'm probably going to get cheaper entries more so than get paid for the longs. I like energy. I think likely this is a year where I get paid for the longs, and I like healthcare, and I'm hoping that's like an emotional hedge. If you watch this show, sometimes I buy stuff that I hope doesn't happen, because if it happens, it means my happiness index in life is going down. And the only reason I bought this thing is to have a financial offset. So my happiness goes down, but the financial offset is there. Palantir is one of those companies. The more powerful and prominent Palantir becomes, my happiness index is probably going down. And so the financial offset is required. By the way, I'll leave you in this. I've never felt less surveilled than in Indonesia. You know what I mean? There's no facial recognition or thumbprint entries anywhere. No shot spotters like in Chicago. And some part of me is like, how many places in the world feel like that still? How many places in the world feel like there's probably not somebody monitoring your phone? I don't know how many of those places there are left on Earth. This feels like one of them. Anyways, all right, I'll see you back here tomorrow, everybody, with the conversation with Ilya Spivak. Wednesday, it's going to be our good friend Chris Vecchio, who I haven't talked to in a while. I'm looking forward to that, and then we'll see you back here on Thursday. For everybody here, behind the scenes and in front, I want to thank you very much. Hit the subscribe button. We'll see you back here tomorrow, same time, same place, same great network, only on Tasty Live. Peace.